more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Live from New York City, welcome to the program on TV and radio. Let's check in on the price action. Your equity market just a little bit softer on the S&P 500. Equity futures negative 0.2%. Total snooze yesterday. Dipped briefly into negative territory and stayed there at the end of the session. So we closed just a little bit lower, but no real drama here. On the NASDAQ, totally unchanged going into earnings from Apple on Thursday and the Federal Reserve decision tomorrow. So a bit snoozy in the equity market. Maybe that's a good thing. In the bond market, we look like this. It was anything but snoozy in the bond market yesterday. Yesterday was kind of strange. We saw the prices paid component of the ISM manufacturing read come in and rebound. And after that rebounded, you started to see Treasuries sell off and yields push higher. Meta came to market as well, so big tech debt offering, which can push the bond market around sometimes. You see those things. Yields higher by more than 10 basis points across the curve this morning, repricing just a little bit lower, down 2 basis points on a 2-year, 4.1182% on a 2-year. On a 10-year, still in and around 350 going into the Federal Reserve. The Federal Reserve widely expected to produce another hike and then go on some kind of conditional hold. We used to say that about the RBA down in Australia, and look what happened overnight. The Aussie dollar, much, much stronger today, positive by 8 or 0.9% against the US dollar. A rate hike from the RBA, a signal there might be more to come, Tom, and a shift, I have to say, from the Australian Central Bank.
Well, yeah, the Australian Bank surprised here, and you think you're going to see a lot more surprises, and I really wonder if we're going to see a surprise here tomorrow and that no one's looking for it. And will there be a surprise in the language?
Where will it be?
Out June.
In the statement?
You know, it's the parlor, as I said in the ad, it's a parlor game. And I don't know where it is, but everybody's, I think, way too complacent about a meeting tomorrow, given what's going on. What I see on the Bloomberg screen, John, in the short-term paper market and in some of the foreign exchange niceties, like you mentioned, AUD, you know, there's some tension out there that's not real. We're distracted by bank stuff.
They've got a ton of things to navigate, and the new one, I wouldn't say it's a new one, but certainly it's been pulled forward, is the debt ceiling debate. The debt ceiling debate after Yellen's comments yesterday seems to have come in maybe about a month. Now, obviously, she's going to say early June, Tom, and there's going to be maybe some time around that, maybe a couple of weeks or so. Yeah. They've got to be conservative, of course.
I have to admit.
But ultimately, it brought the conversation forward.
It brought the conversation forward, and early June is like tomorrow in Washington talk. All of a sudden, it's tomorrow talk. So let's talk to an expert on this, the dynamics, the deepest part of our financial system, foreign exchange. Head of foreign exchange strategy for the global basis at RBC. Elsa Lingos joins us right now from London. Oh, I guess we got some technical issues. Tell me, Amy, where we are right now. Okay, she just went away from us, and that happens sometimes. The signal, you know what happened?
Did you cut the line?
Cassidy.
He cut the line.
He goes, Gerard Cassidy's in London with RBC, and he's like, wait, I get airtime with surveillance, not Elsa. He yanked that cord right out of the wall.
Do you want to hear what Bank of America's got to say before we try and reestablish with Elsa? Yeah. This is what Mike Gapen's got to say. Enough juice for one more hike. He says the handoff to 2Q looks soft. We expect the Fed to hike by 25 basis points next week and signal a pause in June with a weak upward bias for rates going forward. How do they signal the pause in June? The space for that.
How do they say that?
The space for that in the statement. Because in the statement at the moment, can I finish?
Please.
Thank you. In the statement at the moment, it implies a little bit more tightening could come further down the road. I wonder how they reword that tomorrow.
They reworded a question to Colby Smith at the FT, not to Mike McKee. Mike McKee's not going to get it because Mike is too tough.
Mike McKee's usually at the end of the news conference.
Yeah, he's at the end and he's brutal. And so they're going to have that statement early on and it's going to be read off a piece of paper. That's the other thing.
As it often is.
It's going to be read. He's going to be looking at the paper as he moves us forward. We move forward to Elsa Lignos with RBC Capital Markets. Elsa, I got to go to what's moving, and I got euro yen from strong yen, a couple weeks ago, out to weak yen now. It is a 5.6 standard deviation move. What does euro yen signal to the global system?
So I think on the yen side signals perhaps that prematurity in looking for yen strength. The Bank of Japan will at some point normalize policy, but certainly not happening anytime soon. For me, what's interesting on the euro side is heading into the ECB meeting later this week, it felt like a reasonably finely balanced decision between 25 and 50. And we just had that senior loan officer survey earlier this morning, just really looking like demand for loans has come off quite sharply and maybe cementing that case for a 25 hike.
Is Europe in recession?
Not yet, but I think the real struggle for people here is how long does it take to happen? You can ask the same thing in the US, you can ask the same thing all across the world. We've seen material tightening in interest rates. That's going to have an impact on demand for loans, for investment, and so on. From my perspective, I think the more interesting question is a relative one. Why invest in Europe at the moment with structurally higher energy prices without the same tax benefits and so on that you can get in the US? And why not take advantage of the Inflation Reduction Act, the subsidies, the slightly lower gas prices, and really relocate investment towards the United States?
How does that shape your euro-dollar call, Elsa?
From a cyclical perspective, I still struggle to get on board the bullish bandwagon. So it's not that I'm a massive euro-dollar bear. I don't envisage us trading back below parity anytime soon, but it's more that I think the case that Euro bulls have been making for dollar underperformance, euro outperformance, a lot of that is already in the price, and I just struggle to see where we get the upside news from here.
I know that it's super frustrating to talk about the debt limit, the debt ceiling, and the debates in Washington, but we kind of have to now, Elsa. It's unavoidable. Do you have any call whatsoever on how you expect the dollar to respond in a risk-off environment around the debt ceiling debate? Is it different this time? Do people flock to it or move away from it?
I think when you speak to investors, we all have a similar view that it's going to get resolved, but it's going to get really noisy in the interim. I think the question people are asking is that resolution, how much discretionary fiscal tightening is going to come on the back of it? I mean, if we were to see a lot of discretionary fiscal tightening, sure, that could be an argument for getting a little bit more bearish on the US dollar. But typically what we see happen is nobody wants to make difficult decisions on spending cuts or tax increases. And so it just gets pushed back. And in that kind of scenario, I don't see that playing out in a short dollar story.
Elsa, there was a game, I'll say 10, 15 years ago, where we would calculate the impulse of flows into the United States and what it would do to the 10-year yield, how many basis points, folks, how many hundredths of a percentage point would it take off? Are we going to have that discussion in the next year where there's so much money coming in to the United States that it drives down yields?
I think the conversation we're having, I look at it from a structural valuation perspective, right? If the United States is a more attractive place to invest in, then you can see an argument why all else equal, the dollar would be slightly firmer. And again, I'm not some massive dollar bull, but I just struggle with this very strong bearish dollar narrative that's out there. You hear people talking about de-dollarization, the end of the dollar status as a reserve currency, and all of that may happen over the next 10, 20 years, but you can't invest on that horizon. And so I think a lot of those arguments are somewhat premature. And, to your point, those capital flows do matter, both for yield, but also for slight dollar strength.
I look also at the simple call here, which is dollar weakness and or strength. The assumption is weakness. What it means for our listeners and viewers. Is it a big figure move that will have an impact on portfolios, or is it the speculative noise of the foreign exchange market?
it pains me to say it's just speculative noise on the FX market because, as an FX analyst, I do think there is good alpha to be had there. But to your point, Tom, maybe the US dollar is not the best place to find it this year. And so maybe investors outside of the FX market can probably afford to pay a little bit less attention to it this year than they did last.
See how polite she is to me?
Very
she wanted to
diplomatic.
stand up and walk off the set.
I'm sure in the future she might do. There's always
She
that
has in
risk.
the past.
Alsa, thank you. Alsa Linios there of RBC. Looking ahead to a couple of central bank decisions this week. We've got the ECB on Thursday. Tomorrow, we've got the Federal Reserve. The ECB, we're looking for a 25 basis point hike. Let's see how big that debate is, whether they should go 50 basis points. I know you're distracted. I know also, this is, okay, let's get to this. You are a subscriber to Autosport.
Autosport, yeah.
Okay,
on
when did
radio,
this
it's
happen?
Great.
When did this happen?
Vet Bill insisted because we're watching early in the morning. I was as confident as I could be, being 1 second off the pace, which is not really confident.
Who's that?
Alonso.
Fernando was disappointed.
This
at
is a
Baku.
couple races ago. No, not at Baku. This is like it's a magazine. It's dated. You can go to
Well,
Autosport website.
how old is said magazine?
This said magazine, I think we're very Bahrain. Aston shocks at Bahrain.
Okay, so you're like a
And
month.
they did.
You're like a month or so behind.
With F1 Sport, I'm like 2 years behind.
Did you watch the race over the weekend?
I watched every minute of Baku. I said, I came in, I didn't get any sleep. I was up until 4 or 5 a.m. at the White House dinner, going to 4 or 5 parties, and came in, I just turned the telly on, and there it was.
And watched the race.
I love that ESPN has only the British announcers. Because, John, if it was American announcers, it'd be Stroll, his story as the son of a billionaire.
What's this?
That
golf.
would be.
This is the golf. They do the golf commentary.
Yeah,
They tell you about
this
the life.
started with the Olympics. Help me, folks. Up close and personal, which John doesn't get, but there was this whole American up close and personal. Lance
It's
Stroll.
always bio. It's
Can he
always
really?
bio.
Yeah, it's all touchy feely stuff, and the British are just like totally
You know why?
focused
Because
on the
ESPN
race.
are using Sky Sports coverage of Formula One, and they're putting on ESPN over here, which I find kind of odd, but that's what they do.
We're going to talk about this, folks, but this is not like baseball where Fenway Park is different from Yankee Stadium. Azerbaijan was like on the streets. In Miami, am I right, Steve Ross built it? It's like a...
I do not like the Miami track. We could talk about this.
I don't have an opinion, but it's totally different, right?
It's like in a car park.
That's like Abu Dhabi's that way?
It feels like it's... No. Miami feels like it's in a car park, in a parking lot.
Okay.
Yeah.
Would you go to the race? The TV coverage is so good. Why would you go to the race? Other than to be in the pits?
The sound of it. The sound of it. The smell.
It smells?
Yeah, just all of it. Sensory overload. Very cool. Very, very cool. I think you have to experience that up front.
Okay. Maybe that we can get from Red Bull or Ferrari or Aston Martin coming up.
We've got
here
Aston
in a
Martin
bit,
next, which is why we're talking about
Do you
this.
think we can get pit? They could take the three of us and we could be like in the pits?
You'll have to talk to him.
Yeah.
Mike Crack's coming up, the Aston Martin F1 team principal.
Very cool.
That conversation just around the corner. Ask him. See if we can do the show down there.
It's that noisy because you can hear it on TV.
You wouldn't hear anything.
Yeah, okay.
You'd have to wear those headphone things.
Oh, could you? Do I get to wear the thing with all the labels on it?
The overalls.
Yeah, they're going to do that to baseball. Right now, baseball has one label. I can just see in 10 years, baseball is going to have the labels all
why
up.
have they been reluctant to do that in baseball?
There's a purity to it. I mean, it's like the Red Sox uniform, the Phillies uniform. It's
great. Well, people are excited for this interview now, Tom. No doubt about it.
They are. I got to read in.
We'll catch up with the Aston Martin F1 team principal. We'll do that next from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden has invited top congressional leaders for a meeting on the debt limit next week. It comes after the Treasury Department warned the nation risks default as early as June 1st. The White House has said it would not negotiate with Republicans over extending the debt ceiling. House Speaker Kevin McCarthy, who passed a debt plan last week, said he would not increase the spending limit without cuts to the federal budget. A top U.S. regulator wants a sweeping overhaul of deposit insurance. Recent bank failures have partly drained a pool of money the government uses to protect banks' clients. The FDIC says that switching to a targeted coverage approach where business accounts get more coverage than the current cap would be the best option. That will require Congress to act. In the UK, there's a sign that households may be past the worst of an inflation shock. Heavy discounting on clothes and furniture pulled down shop price growth for the first time this year. Shop price inflation slowed to 8.8% in April, down 0.1 of a percentage point from March's high. But grocery bills kept climbing, hitting an all-time high of 15.7%. More job cuts on the way at Morgan Stanley in the midst of a deal-making slump. Bloomberg's learned that senior managers are discussing plans to eliminate about 3,000 jobs by the end of this quarter. Morgan Stanley has about 82,000 employees. Many of the cuts are expected to take place in the banking and trading group. And HSBC will buy back as much as $2 billion of stock. The London-based bank will also resume paying quarterly dividends for the first time since 2019. HSBC first reported quarter results that beat estimates. Pre-tax profit tripled to $12.9 billion. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
I think the resiliency that you're seeing in terms of that consumer spending speaks to the fact that so much of a mess was cleaned up during COVID from all the stimulus programs and all the time that people were forced to spend at home. And that strength is now coming in, and it's an asset and a buffer for this economy, and it's showing up in those consumer earnings results.
Laurie Cavacina there of RBC Capital Markets. Great to catch up with Laurie. It always is. On the equity market, you get a bit more earnings this week. Thursday, after the close, it's Apple. A ton of central bank decisions. We had the RBA overnight. They hiked interest rates by 25 basis points. A surprise against the consensus view, looking for the Fed to go 25 tomorrow and potentially the ECB to do the same thing on Thursday. Just to bring you an update on the debt ceiling debate. So yesterday we heard from the Treasury Secretary Janet Yellen in a letter to Speaker McCarthy and other congressional leaders from both parties. The Treasury said, our best estimate is that we will be unable to continue to satisfy all of the government's obligations by early June and potentially as early as June 1st. After that, we learned pretty quickly that the president had set a high-stake debt limit meeting between congressional leaders, invited them to meet on May 9th. I would have to say there's a bit of distance for me between being urgent about June 1st and then saying, May 9th we're going to have a meeting, which is a full week away, but there we go. McCarthy agreeing to that May 9th meeting, according to a GOP aide in the last hour, Tom. So next week, all to play for. The beginning of a long, long road towards the X date.
They get a Fed meeting. They get some jobs data is critical. I believe that's May 5th or Friday in this hugely busy week. I don't think they really care about it. My take on the White House Correspondents' Dinner is they're completely focused, as they should be, on the election. And it's all politics. It's got nothing to do with economics or analysis or what CBO thinks and the rest. I just think it's a political ballet on May 9th.
If it's all politics, May 9th and going into the debt ceiling debate, then ultimately it is for the election, isn't it? Isn't this about setting the stage for the election?
Setting the stage and placating your constituencies more than anything. I'm not sure what Joe Biden's constituency is. You know, you know, is he playing to the middle? Is he playing to liberals? I don't know. I think we got to learn something about that.
Let's see if we learn anything next week. We'll see.
Well, we'll see. This week we're going to learn something. It's incredibly busy this week, and sandwiched in it all is Uber's earnings. Of course, Uber, even more important now, is their competitor, their small competitor, Lyft, with some real jobs cuts. We're going to talk to Mandeep Singh about this, senior tech analyst for Bloomberg Intelligence. Mandeep, I've got one question for you. It's a hugely cultural question around your expertise on Silicon Valley. So I'm going to rip up the script here at the beginning before we get to Uber. What are people in Silicon Valley going to do today? Are they going to be comfortable switching from their bank, First Republic, to a ginormous monstrosity like JP Morgan? Culturally, can people like you make that switch?
Well, so, and now you can throw Apple in the fray as well, because, you know, they're offering those kind of yields where they're trying to attract consumer deposits. So look, I think right now everyone realizes that, you know, you have to get some yield on your cash, and there is safety towards larger banks. But I think Apple's entry in this space is quite interesting because clearly they have a long-term vision in terms of what they're trying to do.
I do agree with that, how they do it without being financial, without being a bank. Let's get over to Uber right now. Just, you know, basically thumb up, thumb down. How is their quarter, how is their year going?
I think I would give a thumbs up simply because, you know, what everyone has realized is the only way you can make money in this business is scale. And Uber, you know, has that scale when it comes to the supply side. Even on the rider side, they have that organic momentum. Now, I would caveat here, Uber's mobility business looks far better. We know that the delivery and freight is a drag on profitability. And when you look 3-4 years out, I don't even know if this company can be a high growth company. So for me, this is more of a margin improvement story from now on. And as long as they keep, you know, mid to high teens growth and keep delivering on the margins, I think you can say it's currently not valued as a tech stock, as it should be. I think all these companies should be valued as a logistics business, but clearly Uber has the scale.
Mandeep, how does that compare with Lyft?
Lyft, I think things aren't looking very good, even with the CEO change, even with the job cut announcements, because they're struggling with the driver supply. And in this business, if you can manage your ETAs, you know, there are no switching costs. Those consumers which were using Lyft can easily switch to Uber or DoorDash. And I think that's what they're struggling with. Now that they have to announce job cuts to improve profitability, that's like a double whammy, and I don't see them coming out of this anytime soon.
Mandeep, is there any lever that Lyft can pull? What can they do?
So we highlighted B2B partnerships. Look, if you start looking at all these companies as a logistics business, they're competing with Amazon at the end of the day, and, you know, Shopify and all those type of businesses that layer e-commerce and logistics together. And that's where, you know, they can partner with a Walmart or a Target. Really, you need scale. That's the number one thing, you know, you need as a marketplace. And the B2B side of things has much bigger scale. That's what Grubhub did,
Right.
You know, partnering with Amazon.
Mandeep, I'm looking at the financial analysis screen of the Bloomberg terminal. You've got something to do with that. And the cash flow switch of Uber from -4 gazillion out to a +4 gazillion 2 years out is extraordinary. How do they flip that cash flow to such a constructive statistic?
I mean, look, I still think it's bloated. They're spending about $10 billion or $9 billion in, you know, cost of revenue and OPEX, and that's too high, you know, a quarter. And that's the reason why no one has understood why these companies are, you know, so bloated in terms of their cost structure. The R&D expense of, you know, $800 million a quarter, that's too high when all of your consumers are coming directly to your app. sales and marketing of 1.2 billion. So clearly, there's a lot to be fixed on the cost structure side, and Uber has the scale, $30 billion in annual revenue run rate. Guess that's what they're doing, paring down the costs, and that's what's driving.
So, John, it's like Meta buys him. I mean, Zuckerberg's now the new cost-cutting king. Meta buys Uber.
You see the Meta debt deal yesterday?
Yeah.
8.5 billion.
Yeah, it's amazing. And, that goes to the heart of it, how Uber is not Meta. I mean, I'm looking at the WACC screen on the terminal, folks, weighted average cost of capital. Mandeep invented the screen. And Mandeep, Apple and Meta are out with a debt cost of 3.3%. Uber's like at 6%. And that's, to your point, is it a tech company? If it's not a tech company, what's a logistics company? Is that like they're really competing with FedEx?
Yes, and they probably will be valued at 6 to 8 times EBITDA, which is what a typical logistics company is valued at. So I think what market is really waiting for is how much the profitability, and look, this is an adjusted number, so it's not even a GAAP number, but they'll get the benefit of doubt as long as they keep executing on that EBITDA line. And I think the delivery side of things, that's where they've started to layer on ads. That's a $500 million run rate business. That will be key to operating leverage on that delivery side, because Uber wants to be that super app, but so far we haven't seen that synergy between mobility and delivery. I think freight is a distraction. They'll probably spin that off.
Putting it all together. 11 companies coming forward with bond offerings yesterday. This really knocked around the treasury market a little bit, Tom. Contributed to that move higher in yields on treasuries.
Wait, interest rates are higher. Why would there be bond offerings? And the answer is CFOs are like lemmings off a cliff. They're looking at the trends. And it's not so much they're saying lock it up, get in there, but they want to create a constant stream as yields go up. And of course, the other side is they're going into the CEO and the board and saying, look, rates are coming down.
Well, they're certainly lower than where they were 2 months ago. That's for sure.
Yeah, and
take the 2-year piece in a treasury market.
What does Apple do?
That maturity's gone from north of 5 to south of 4 at one point. A little bit north of 4 at the moment.
Let me get it up for Apple here. We can do this on the Bloomberg, folks. WACC go. Apple, oh my word, they have 5.1% debt. I mean, it's a crushing burden at Apple. They're not going to announce this the day of the earnings, which is tomorrow, the next day rather. But a week afterwards, they come out and they just do a debt offering to do a debt offering. They have 94.9% equity, which is VBOD 101 is not what you do.
First look at Uber. First quarter revenue, $8.82 billion. The estimate, 8.72. It's a small upside surprise. That's first quarter revenue. This is their outlook for second quarter adjusted EBITDA, 800 to 850 million. The estimate, 757.7 million. So slight upside surprise there too. We're up by 3.8% in the pre-market on Uber. Tom getting a little bit too excited about this interview with Aston Martin F1 team principal. It was not now. It's in the next
Mercedes.
hour. It's in the next hour. It's about 50 minutes away. You're excited?
Yeah, I'm reading it.
Okay.
The moment news breaks, no one covers the world like Bloomberg.
It would be, of course, a total disaster for Emmanuel Macron because he's been elected on this reform and he would have to basically start from scratch.
It definitely is an exciting day for Apple. First store in India, here in downtown Mumbai, a second one coming up in Delhi.
TK, we've got a lot to talk about.
Debt, China, and the shockingly cautious view the IMF has on the view 5 years forward.
Bloomberg, your global business authority.
Forget a degree in finance. Go for a career in tech instead. That's the advice from the latest Bloomberg survey of professional and retail investors. Only 1 in 5 Wall Street professionals say high school seniors graduating this year should follow their footsteps and go into finance. About half say that Gen Z's best bet actually lies in the tech sector, and that's despite all those recent layoffs at companies like Meta, Amazon, and Google. Still, hiring trends paint a rosy picture for those with a background in tech. Industries ranging from auto to the federal government have jumped at the chance to recruit any laid-off tech workers. A degree in tech could set you up for a lot of potential jobs and a safety net if any of those jobs don't quite pan out the way that you'd hoped. Survey respondents also expressed concern about the long-term threat of AI. Think ChatGPT taking all of our jobs. For kids graduating from kindergarten this year, about 40% of investors said to go into healthcare. That way, when they come of age, they may be able to hedge against any potential AI-related job takeovers. Roughly 12% said Wall Street would be the right career given that pending AI threat. The AI concerns come despite traders themselves finding that current iterations of ChatGPT struggle with things like math and corporate earnings. But the idea here is that there's still plenty of time for AI to improve and to potentially threaten our jobs along the way.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
Could face bigger challenges next.
Was going to keep rain World Cup. This is a 3.
As the economic picture down. The BOK is getting ready to make a decision.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
It just makes sense for First Republic to be a part of a large money center bank like JP Morgan.
The fact remains that there is still a fair amount of stress in the banking system.
There clearly is something systemic here. I think the question is whether or not it's only within banks that interest rate risk has been mismanaged or whether there's a general problem.
It's hard to divorce the Fed's actions from what's happening in the banking sector.
The sad thing is the Fed is going to now regulate these smaller, medium-sized banks when it was Fed policy itself that caused this crisis.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Farrow. Your equity market negative 0.1% on the S&P 500. What a week we've got lined up for you. Down in Washington, the Fed's two-day meeting begins, led by Chairman Powell, concludes tomorrow. This market looking for a 25 basis point hike, and then, well, then who knows? Maybe a pause from there. Then on to the ECB on Thursday, on to payrolls on Friday. After the bell on Thursday, Apple earnings just around the corner as well. TK, that's a big couple of days ahead of us.
Huge couple of days is the character of it, and some of the surprises along the way, like the Meta bond transaction of yesterday. We've got the Uber earnings. We can get to that Marriott out moments ago. But to me, what it is about, John, is a summation of we're here. We're at some restrictive point. We've seen the Fed come on. And frankly, June is way more interesting than this early May.
You want the earnings? Uber came out moments ago. First quarter revenue, $8.82 billion. The estimate, $8.72 billion. Upside surprise, stock is higher in early trading.
Are they a monopoly?
Marriott International, here's one for you, Tom. First quarter revenue, $5.62 billion. The estimate, $5.39. First quarter EPS, $2.09. The estimate, $1.85. Better again. And they've raised their guidance for the full year 2023. The stock is higher by 1.6%.
Part of that travel business, I guess Uber's sort of the travel business. I guess I don't want to go there, but the fact is they're both about moving people around in an economy. I think the recession talk has ebbed a little bit. I mean, it's sort of like a stagflation talk, like a 1% talk. I don't see a lot of negative GDP chit-chat out there.
It depends what you look at. You go to the airport, show me a recession. Yeah. Absolutely crazy to travel right now in America and across Europe, I'm told as well, Tom.
Yeah, I think it's great. Of course, we got the follow-up on the bank news with some brilliant stuff. You mentioned it earlier, but we really need to signal out, folks. You need to get smarter on the bank stuff. Start with Matt Levine and John Authors. They absolutely kill it.
He was fantastic.
For Bloomberg Opinion. It's like I get goosebumps over the acuity of how both of them are writing on this in their each and own different ways.
Can I go back to that quote from Robert Hockett, a professor at Cornell?
Yes, yeah.
In Author's piece. This is so important. We now have two choices before us. Either we preserve our production-focused regional and sector-specific industrial banking systems by removing FDIC insurance limits immediately, or we allow financialized Wall Street banks to take all. He goes on to say an outcome that will ultimately necessitate nationalization of the whole sector. Now, that sounds like pretty extreme, pretty drastic stuff, but did we take a step towards that kind of scenario yesterday?
And the keyword there's financialization. I was talking to a fan from Australia last night, and I said, look, I'm sorry, this stuff is complex. And Dr. Alaria, an expert in game theory, was channeling a gentleman still alive named Lipsey in Lancaster, and I think it's in the 50s. Lipsey and Lancaster wrote a definitive paper on the second best choice. This is really important. We're also simplistic. We look at the best choice out there. And if you can't make the best choice, what happens when you go, oh, God, I guess we'll sell it to J.P. Morgan? And those are totally different dynamics. And there's theoretical foundation, as Alarian talks about, to the actions of surprise we saw yesterday.
And these second best choices that central banks have to confront now, starting with tomorrow, the Federal Reserve. Let's touch base with a price action for you, just briefly on the equity market. The S&P 500 negative by not a whole lot. We're down by 0.16% on the S&P 500. If you check out the bond market, yields look like this on a 10-year. We're down about 3 basis points, 353.57 on a 10-year. And just to finish on the euro, inflation came in a little bit hot in the Eurozone a little bit early this morning. Still sub 110, 109.60 on the euro, Tom. On that currency pair, negative 1/10%.
3-month LIBOR, 5.34%. When do we start talking about six handle on some of these short-term rates? I mean, that's inflammatory. I get it. We're doing TV, folks. Stay with me. But I'm sorry, that's a big number.
I'm with you. Sure, but this is going to depend, Tom, on how far the central bank's going to push it. And if the RBA is any kind of example of what we might see from the Federal Reserve in our future, a hawkish surprise, I'm not sure we're looking for that right now.
Yeah, it's interesting to me as well. Should we get to our guest?
We should. She's around the table with us, usually on the other end of a camera. Anna Han, good to see you in person. Thanks for being with us. From Wells Fargo, as Tom just moves his Autosport magazines away from
moving. You want to read a copy?
The table.
We have Aston Martin coming up. Do you watch F1?
I do. We spoke about Lewis Hamilton last
You're
time.
a Mercedes fan, aren't you? We'll catch up with Aston Martin later this hour. We'll talk about Fernando, who's rumoured to be dating Taylor Swift, but...
Fernando is?
Yeah.
Oh, my word. I'm so far behind in the gossip.
On the internet gossip, the rumour that Fernando is dating Taylor Swift. That's a story for another time. The Wells Fargo equity strategist joins us now to talk about stocks. Anna Han, you and a team. Chris Harvey, leading the way for equities at Wells, looking for a 10% correction at the headline S&P 500. What is it that you see that's going to lead to that correction?
We're seeing really margin compression. We think that earnings are slowing. And right now, where earnings projections are as we go through Q1 reporting, they continue to believe pretty much a flat growth year over year for the S&P 500. We think that's too optimistic. So we're bringing our EPS number down about 10% contraction in EPS growth. We think that's very reasonable in an environment that you expect GDP growth, slowing consumer, and still inflationary pressures. So you put that and you tack on still a pretty reasonable multiple of 18.5, that brings us lower.
How does tech absolutely crushing it over the last week factor into your call?
Absolutely something we're watching, but we think that it's getting a little ahead of itself right now. You are seeing as well, why is that running ahead of itself? The yield markets. You're down with the 10-year around 3.5. That is a move already expecting Fed cuts. The market is expecting cuts after this meeting. And again, that's just too soon for us. I think that realization and people having to move forward or out their expectation for monetary easing is going to make things a little tougher in this summer.
To challenge your mathiness at Yale, and I'm thinking of Nassim Taleb, the great quant finance guru, on the tail risks out there. If I look at the tails of the distribution, the risks of the distribution, good and bad, out to next year, can you see them, or is it as opaque as you've ever seen?
I certainly think there are things top of mind, actually, and that's what's got things so interesting. We know what to look at. We're just not sure how to weigh each one. For example, we're looking at the commercial real estate space. That's been a hot topic. What's going to happen if those loans can't get renewed? Another one is student loans.
Right.
How does that impact consumer spending if student loans don't get dismissed? We're looking at these kind of factors. And as well, what if the Fed really doesn't start cutting? What if they just pause and hold because inflation is
that's the litany of worries that all of our listeners and viewers have. There's got to be a good side of this, and that the SPX has recovered from a great bear market. We're back to negative 3%, whatever it is, 12 months trailing. You're basically saying take the summer off and take the rest of the year off, right? When you take the summer off under Anna Han, Wells Fargo Economics, do you go to cash? How do How do you take the summer off based on your 4,200 call?
I think actually rather than go full cash, we're not that bearish yet. We do think you can weather through this by looking at those secular growers. I still think there's opportunity. And you look in the cap goods space as well, for example, and you're seeing that volumes are actually holding up. And all other sectors, especially even in something like staples, like food area, you're seeing volumes shrink. So there still are opportunities to keep that growth, to plow through what could be that rough summer we talked about.
I know it's difficult to identify specific names with you, so I'm going to be delicate about asking this question. Are the cloud names secular growers still?
Oh, well, you know, as someone who believes in that technology and certainly uses it and believes in the computing power of it, I do still think that there's growth opportunities. But like we said, especially with the software space and tech itself overall has had such a hot run, it's not somewhere where I'm ready to really pour in the investments now.
So what is a secular growth story that you do want to get behind at the moment?
So besides the crop goods space, where we do like as well media and entertainment, and now again that too has had a great start to the year, we still think that it's attractive. We still think there's opportunities, and a lot of it is thinking about where consumers will continue to spend even as they have to tighten the belt. And part of that is really in the experiences and the services that they can enjoy.
Can we get an extra level of detail here? Is this Tom spending more money on streaming apps? What exactly are you talking about?
It could be him watching more F1 and spending there. That certainly is true. There is that push. But again, it's more of what is going to relatively outperform when people start pulling back on their spending, pulling back on the revenge travel spending you were talking about, how those prices in airlines are still expensive.
So you think the airline story is done? Can I go that far? Do you think it's done?
I wouldn't say it's done, but it's not somewhere where if I had cash to put to work, where I would rotate into right now.
Okay, TK, that sounds like it's done.
I look at the Wells Fargo economic call and you know, your economics team looking at where GDP is. Is there enough nominal GDP to keep this game going? To me, that's the heart of the matter. How do you fold in Wells Fargo economics into your equity analysis?
So our expectation for actually GDP growth is just above 1% for this year, but pretty much a flat 2024. And that is concerning, but I think the sharpest pain points where we see the most GDP contraction is 4Q and 1Q. 4Q of this year and the beginning of next year is going to be the toughest drop in GDP. But that doesn't necessarily align with when we expect to see the toughest earnings contraction.
Okay, just to be specific about that, just final question. When is that earnings contraction? What's the window that you and the team are looking for?
We think really it's this year, and we think it's already occurring. You already have been seeing those margins come under pressure, and you've seen that 4Q of last year earnings came in a little lower than projected. I think that continues, and these are the quarters now where it's going to be toughest. That realization is what's going to push equity multiples and equity levels lower.
Anna Han of Wells Fargo. Anna, great to do this in person. Wonderful. Really good to see you. Thank you. The team at Wells Fargo looking for a 10% correction in the next 3 to 6 months off the back of earnings, Tom. Apparently we're about to go through a rocky patch.
Points. I mean, you're going to go 4,200 down to what, 3,800, 3,700?
Which is basically the range of the year so far, 38 to 42.
Yeah, I think everybody's got an opinion here, and it centers to me around this recession call and economic mind. As I said, I think the recession call's drifted away a little bit.
It has been pushed back.
Yeah.
At what point did the bears just capitulate, stop pushing back the thesis?
I haven't felt that yet. That's a really important question.
I haven't seen it either.
I haven't seen mentally fear of missing out really jump in, except in the tech, and that's a little different story, like we'll see with Apple on Thursday.
Anne Milletti at Allspring Investments. She's going to join us in about an hour. Looking forward to that conversation. And later this hour, we'll catch up with the team principal of Aston Martin F1. I'm convinced you're actually just reading in. You're doing your Aston Martin research.
I got my Mercedes magazine here because
how much is an Autosport? How much is an Autosport subscription? What are we talking about?
Well, you get it, but it's got the British font, which I can't even read. I need a magnifying glass to read.
What is that? $10 a month?
It's like it's like huge. It's like $500-600 a year.
Seriously, that much money?
Yeah. Well, I have a full digital package, and I get. They're in the pits during the race, giving me.
You're like you and 2 other guys in Manhattan have that subscription.
Here, what's next for Mercedes?
From New York City.
There you go. We're giving out party favors here.
Down 0.1% on the S&P. This is Bloomberg.
I was waiting for that sound effect. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. President Biden has set a high-stakes meeting for next week on the debt limit. The Treasury Department warned that a potential default could come sooner than expected. The president will meet with congressional leaders. Republican Kevin McCarthy, the House Speaker, has said he won't extend the debt limit unless there are trillions in cuts to the federal budget. Underlying inflation in the euro area slowed for the first time in 10 months. After stripping out volatile items like food and fuel, consumer prices rose 5.6% from a year ago in April. That backs the case for the European Central Bank to slow its most aggressive interest rate hiking campaign ever later this week. The White House National Security Council says Russia has suffered more than 100,000 casualties since December in the fight over Bakhmut in eastern Ukraine. That includes 20,000 dead. The commander of Ukraine's ground forces say they have pushed back Russian troops from some positions in Bakhmut. Uber reported first quarter earnings that beat estimates. Consumers continue to spend more on rides and food takeout despite rising prices and an uncertain economic outlook. Uber saw fewer than expected monthly users. Still, ride-hailing bookings beat estimates, and that's an indication customers are taking trips more frequently. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. ECB is expected to hike rates, but how high will rates need to go, and how fast will they get there?
Are we underpricing here in Europe, and just how far the ECB could still go?
We really haven't seen an impact from the hiking cycle on inflation yet.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference. Coverage begins Thursday on Bloomberg, your global business authority. Looking for another rate hike.
They're going to be looking at the momentum of the economy.
It's not too hot, not too cold. The Fed's kind of stuck in the middle.
But will they signal a pause?
A dovish hike would ease financial conditions. A hawkish hike could destabilize things.
The parlor game of the American economy.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Uncertainty has gone up. Uncertainty has gone up a lot.
The Fed's goal is not to send the economy into a deep freeze.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
We've got a lot to do, and the most immediate thing we can do is ensure the continued reliance of our economy and the financial system. The most important thing we have to do in that regard is to make sure the threat by the Speaker of the House to default on the national debt is off the table.
The President of the United States speaking there on the debt ceiling in the United States of America. Janet Yellen, the Treasury Secretary, with a wake-up call to start the week, writing in a letter to Speaker McCarthy and congressional leaders the following. Our best estimate is that we will be unable to continue to satisfy all of the government's obligations by early June, potentially as early as June 1. The actual date that Treasury exhausts extraordinary measures could be a number of weeks later than these estimates. Tom, a bit of a wake-up call, I would say, not just for congressional leadership, but also for the administration as well, who offered a meeting to Speaker McCarthy and others as soon as May 9th. We understand, according to a GOP aide in the last hour to start this morning, that Speaker McCarthy will be attending that meeting.
This is real politics, and it's really important with the modern polarities that we have, John. This is a fact that they have to get it done, and I think that's one trump card the president has. He has decades and decades of experience of getting it done. I would go back to the Watergate era, where you had Howard Baker, Sam Ervin, and others understanding with President Reagan, you have to get it done. And that's missing today. Maybe that May 9th meeting gets you there.
If it is June 1, and it could well be a number of weeks after that day, and Treasury has acknowledged that fact, Tom, it is a solid month or so earlier than I think a lot of people thought it might fall. This, of course, comes off the back of the tax receipt data that we got a number of weeks ago, which indicated that might be the direction of travel. But here's the point that I want to make this morning, Tom, off the back of this. June 1 sounds urgent, important, let's get things done. Waiting a week to have a meeting doesn't sound that urgent, does it? Waiting a week? May 9th?
No, I agree. I mean, I totally agree with that. I mean, it's waiting a week to get more data, and also, frankly, to see what tax receipts do as well. Anne-Marie Horton joins us now, Bloomberg budget correspondent, and we go, Anne-Marie, to a May 9th meeting. Let's frame the look here. Politics is all about the look, Anne-Marie. Is it in the Oval Office, on the Oval Office couches, with everybody smiling?
I presume so. I have not been briefed on the optics, the look and feel, the style of this meeting, but normally all these meetings, as the President of the United States, they happen in his Oval Office. To John's earlier point, the reason why likely this is not set for this week, given the fact that the Treasury Secretary is saying the ex-date, the time that Treasury can exhaust their special accounting measures they've taken since January could be as early as June 1st, is the House is not in session right now. When President Biden picked up the phone and called Speaker McCarthy, he's in Israel leading a Kodel there. He spoke to the Knesset yesterday. So this is also probably why they have to push it out to next week.
Sure.
And this also just shows how short of a timeline these individuals have to get a deal done, because the House is on recession in recess this week, and then there's going to be another recess for both these chambers. We're working about 3 weeks here, and in that time, the president is also going to be abroad in Japan and Australia.
And the travel itineraries there, I'm sure you'll be with them. Anne-Marie, the answer here to me is there's a process, not so much who blinks first, but who sits down in the Oval Office on May 9th and says, we ought to do this? Is it Biden or the House?
Well, Biden has decided to invite the leadership of Congress. So that's Hakeem Jeffries alongside Speaker McCarthy, of course, McConnell and Schumer. McConnell has made it very clear. Now, this is Mitch McConnell's obviously Senate Minority Leader. He's the one Biden was able to get a deal done when we had this problem last time. But he has really said that he is going to defer this to Speaker McCarthy. And I don't think we're there yet where he is going to step on the Speaker's toes. He's going to let him lead those negotiations. But to provide some cover, the White House invited all four. So congressional leadership is all invited to the White House for this meeting. We do know that Speaker McCarthy will be the one that's he has accepted, and all eyes will be on him because he's been asking the president for another meeting since they first sat down February 1st. And in that time frame, Speaker McCarthy was able to get a win. President Biden kept saying, show me your plan. Well, he did. He showed him his plan, and he got it through his House. So now really the ball has been in the White House's court. The issue is at the moment, the White House continues to say they will not pass a bill regarding the debt ceiling that is not clean. And that is something that Speaker McCarthy says he will not do as well.
So, Anne-Marie, walk me through how you think this is going to play out next week. Get to May 9th. What does May 9th look like?
May 9th is a conversation in the Oval Office. If the ex-date is fast approaching on June 1st, potentially what many are saying is you can just see this kick the can down the road, but I'm not sure how far they're willing to do that. Maybe they kick it to September when they have to come up with a budget. There could be a path potentially where every side has a little bit of a win if they go to September and at the same time they pass a clean debt ceiling bill, but also a budget that has spending cuts. But potentially they are separate bills. So McCarthy could come out and say, yes, we were obviously raised the debt ceiling, but we did so by extracting spending cuts. And Biden can say, I was always up for negotiating spending. The issue was I wanted a clean debt ceiling bill. That's one potential. But there's a number of ways this can go. Some are saying potentially it gets cut in the Senate, and then Democrats in the House are the ones that have to sign up for it. And Speaker McCarthy potentially that will lose some of his members of the far-right caucus. This can go any number of ways. The big issue is they don't really have a lot of time.
We haven't talked about Senator Manchin a lot recently. He talked yesterday.
Good point.
He was a key player in passing the Inflation Reduction Act. Anne-Marie, what did he have to say yesterday, and how could that factor into these conversations?
Well, Senator Manchin has been a headache for the administration throughout really Biden's entire term, but most recently, there's some parts of the Inflation Reduction Act he does not like how it's being executed that he voted for. But also, he was the one that came out, and after Speaker McCarthy was able to pass his debt ceiling lift plus spending cuts package through the House, Manchin said it is time for President Biden to sit down with McCarthy. Manchin made it clear he doesn't agree with everything that went in that bill, but he said the bill right now is the only game in town. It is the only debt ceiling rate bill that raises the debt ceiling at the moment, and Biden needs to get in a room with him, and that's what we're seeing happen. That's going to happen May 9th.
We've all seen this movie before, and we know the ending, or at least we think we do. And this is kind of how we started the conversation on this program this morning. Tom and I were talking this over, Anne-Marie. I'm sure you saw some of it. Is there a sense in Washington from people you speak to that it might be different this time, based on how things are going?
I think everyone tries to say we've been here before, as you just mentioned. We will always get there. The concern is, of course, with how fractious you have the Republican Party, especially in the House. Many people will point to the 15 rounds it took for the Speaker, McCarthy, to become the Speaker of the House. And that there's many in his party who want such deep spending cuts that no Democrat is ever, or even some centrist Republicans potentially, would never sign up for. But obviously the bill they've passed, that's their beginning negotiating salvo. You're going to always get less, not more. But there is concern that potentially this time is different, and many are talking about 2011, when the U.S. was downgraded. Even though there was negotiations happening at the time, the U.S. still was downgraded at that moment. So that's what everyone is pointing to. That's what the concerns are. I think we'll have a little bit more clarity May 9th.
There's always something to worry about. AMH in Washington. Anne-Marie, appreciate the coverage. I'll catch up with you a little bit later this morning to go through all of this all over again. And hopefully we've got an update from someone down in Washington. Here's an update from Citigroup. The team led by Andrew Hollenhorst looking forward to the Federal Reserve tomorrow, and the communication of Chair Powell and the team saying this: financial stability risk can never be taken off the table, but the acute period of negative headlines looks to have passed. The team at Citi saying that means the Fed policy path once again becomes a function of incoming data. Tomorrow's statement, they say, will likely keep options open for further rate hikes beyond the 25 they expect tomorrow.
Sounds about right. And what's important is people looking for low rates, I think, would say the same thing. We got past June.
Terry Wiseman of Macquarie in the studio, joining us next. Looking forward to that from New York. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
In a couple of hours, the Federal Reserve wakes up in Washington. I stress in a couple of hours because it's still early days, Tom, down in D.C., isn't it? 7:30 Eastern Time. They take their time in the mornings.
8:30 is early.
8:30 is early.
8:30 is early.
8:30 is early.
Yes.
8:30 is
I've
like in New York,
experienced
6 a.m. in Washington, D.C. They'll be waking up shortly and starting their two-day meeting at the Federal Reserve. That concludes tomorrow. 25 basis point hike, very much on the table. After that, who knows? Here's the price action going into it in the equity market, negative 0.15% on the S&P, totally unchanged on the Nasdaq. A snooze yesterday, no relief rally in the equity market yesterday, even with the banking solution at First Republic acquired by JP Morgan, and no relief rally in the regionals either. The KBW Bank Index more broadly is basically unchanged, didn't really do much at all. Outside of that, into the bond market we go. This did reprice yesterday, which was pretty interesting. Tons of corporate debt supply came to the market yesterday. Yields pushed higher. We had an ISM manufacturing read with the prices paid component. Just a read on these kind of things, pushing up prices, and yields were higher off the back of it too. So yields were actually up by more than 10 basis points across the curve yesterday, including at the front end. We're at 4.1286% this morning. We're down about a basis point on a 2-year. I wanted to finish on foreign exchange and have a look at Australia, just briefly. The RBA coming out with a surprise rate hike. Consensus was no change. They delivered 25 and signaled maybe more was to come. The Aussie stronger by 1 full percentage point against the US dollar this morning, Tom. Teeing us up for a broader conversation about hawkish surprises around the ECB and the Federal Reserve through the next 48 hours.
It is out of China reopening. The reports out of China on their May holiday is it's absolutely packed with a consumption oomph in China. And Australia is hardwired into that, going north across the Pacific Rim.
I understand from the team here at Bloomberg Economics that it's a little bit different, that maybe they're willing to tolerate softer growth in favor of focusing on bringing inflation down in Australia. A shift, if you will, around the balance on those two things since the last meeting.
And it's a cultural differences nation to nation, as New Zealand is acclaimed for being rules-based as well. Right now, and this is a joy, as John and I continue our coverage of this banking crisis, it pays to have somebody with real-world experience. He is global currencies and interest rate strategy at Australia's Macquarie, but far more, Terry Weissman is something that has lived what so many other people are doing. I want to go back to Alan Schwartz, David Malpass, John Riding, you, Emmy Shio, and it blew up in March of 2008 at Bear Stearns. From your distance, but your tangible experience of collapse, how is JP Morgan different in 2008 than JP Morgan is in 2023?
Let me, instead of speaking about JP Morgan, Tom, let me just talk about the banking sector generally. 2008 was, I think, qualitatively different than the situation we're seeing now for the banks in the United States. In 2008, you had a situation where the primary problem at the banks was the asset side of the balance sheet. It was generally a situation where there were too many mortgages that went bad too quickly. That's an asset side problem. It's a collateral side problem. What we're seeing now is different. What we're seeing now primarily is deposit flight. In other words, it's a liability side problem. It's lack of confidence in the banks. Yes, it may be lack of confidence in the banks because people are worried about their ability to continue to honor their obligations, their liabilities, their deposits. But nonetheless, this is a crisis that has started from the liability side. And I think that makes it qualitatively different. It actually makes it easier for entities like the Federal Reserve to solve, because the Federal Reserve has backstops. It could come in and replace the liability side that the banks are losing.
Right.
If $1 of deposits leaves, the bank can simply go to the Fed and borrow on the primary credit facility or from the new BTFP and get that dollar back, rebuild its base of liabilities, and continue to do what it's doing. So I think this is qualitatively different than 2008.
And can interest rates assist government institutions, and can interest rates assist J.P. Morgan here by getting the wind behind them over the next 1, 2, and 5 years to make this easier?
There's nothing better in promoting confidence than economic growth. Nominal income growth, certainly, because obligations are typically in nominal terms. But if you can't get nominal growth, you might as well just get real growth. I guess the question comes down to, do lower interest rates help growth? I think they do, right? If the Fed were to lower interest rates these days, certainly you would get some inflation, presumably, but that would be coincident with nominal growth. It would help corporations, bank, and every obligator in the economy honor those obligations, honor their debts. I think that would reduce the amount of financial stress in the economy.
Let's talk about something that's not promoting confidence. The debt ceiling debate down in Washington, D.C. People are already exhausted about it, and negotiations haven't really even started to get going. Now, Terry, you've got a different view on this. Can you just walk us through piece by piece? And we have time to do this. So just go through piece by piece why you think this can get addressed.
Well, first of all, we've had examples of a debt ceiling crisis in the past before, and they have found resolution. Now, I'm not going to say that this is the same, but I think the differences today are political. They're not really economic. Why do I say that? Because Kevin McCarthy wanted the acclamation of his party to become Speaker, and he had to make certain promises. And among the promises he made, given that this was January and we were already coming up against the debt ceiling, Janet Yellen had said so in January, one of the promises he made was that he wasn't going to back down with respect to getting out of the administration what he wants in terms of spending cuts if he's going to go with a debt ceiling increase. Unfortunately, he got the speakership, and now he painted himself in a corner because he made that promise to his caucus, and he can't really back out that easily. So now you have a hard stone coming up against a hard wall, et cetera. You've got two intransigent sides. I actually think that we might come down to the wire, and I actually think that the way we may resolve this is not through the traditional means of a debate and negotiation that results in a compromise. I think we may approach a crisis, but I think the cleaner solution here, if we don't get to a political resolution, is simply for the U.S. Treasury to continue to do what it's doing, i.e. issue debt, and get challenged in the courts by the opposition. Now, remember, they've already passed the spending, so there's some legal basis for the view that they have to issue the debt to support that spending, because that was a bill that was passed. But what happens at that point? Well, I think it will go immediately to the Supreme Court. I think the Supreme Court could issue an injunction. I think the Supreme Court has legal basis for doing that. They have Amendment 14, Section 4 says the debt of the United States will not be questioned. And that's a legal basis for telling the administration, you can do what you want. And if that happens, by the way, it'll put the debt ceiling situation on ice forever, because now you have a clear judicial ruling. So that's a clean way to do it. There are other.
It doesn't sound too clean. Let's just
look. I mean, to come in here and have the Supreme Court, which is co-equal to the other two branches of government, and effectively say, no, this is our purview.
The outcome would be clean, sure. The process, not so much.
It can happen in the course of 48 hours. You don't really need, a lengthy hearings on the part of the Supreme Court. They have the Constitution right there. They can read what Amendment 14, Section 4 says. It's very clear to me. You should read it yourself. I mean, it's undeniable that this is not something that's constitutional to intentionally let the payments go unpaid. There's another way to do this, of course. The Treasury has hundreds of billions of gold in storage, right, at Fort Knox. One way to do this is simply to issue gold certificates to the Federal Reserve and have the Federal Reserve continue to fund the government government's operations through this period. That's a solution. Look, there are a few workarounds. People have proposed these. You can go on the web and you can read them, and they happen to be cleaner than the messy situation we might get ourselves into in the next few weeks.
This is a dissertation, folks, on the history of debt coming out of World War II. Terry, how much of this is almost religious in nature? We have a culture in this America. I'm going to generalize, it's Calvinist, but that's unfair to the gentleman from Switzerland. Debt is bad. And Heilbronner and Bernstein wrote a classic monograph on this 30 years ago. Debt is bad. We've got to get rid of debt, and then we don't, do we?
Right.
I mean, to me, there's a whole cultural overlay here that's unspoken.
Yeah, debt in support of investment, debt in support of assets being created in the economy, debt in support of more productivity by way of that is good. Debt in support of more spending without a concomitant amount of savings on the other side is bad, especially when that debt rises to a point where the income that's generated by the spender is no longer sufficient to honor that debt, to support that debt, to support the obligations of that debt implied by that debt. So I think debt is perfectly fine. It's an aspect of the capitalist economy with limits, right? It depends where it's going, what activities it's supporting effectively.
So let's get to the market question. Is there any risk? What is the risk outside of the so-called at-risk securities in the T-bill market? What is that risk? What does that look like?
Well, look, a lot of people say that if there's a missed payment on a principal payment or missed coupon payment, that Moody's will put the U.S. in default, or S&P will put the U.S. in default, and then that will trigger CDS payments on the swaps. I think that is not realistic, and I say that with reference to the fact that unlike a corporate bond or a corporate obligation, U.S. Treasuries don't have cross-default provisions. If I as the U.S. Treasury do not make a payment on a single bond, it does not accelerate the payments on every other obligation that the U.S. Treasury has. Yes, you can say maybe that bond has defaulted, but the corpus of debt has not defaulted. There are no cross-default provisions. And that's tricky because you have to think of a default as something different, and Moody's would have to think about it as something different than they would if the similar thing happened for a corporate issuer. And that's tricky. That calls for a judgment call at that point. And it's not too clear to me that even if a payment is skipped, that Moody's will go that far because it has that out. They can avoid calling a default. We could avoid going to triggering CDS.
What would that mean for things like collateral? Treasuries used as collateral for all types of things. What would that mean?
Well, look, the collateral, the value of the collateral is only as good as the price of the collateral. So to the extent that we're talking about a few pips change in the price of those treasuries, yeah, you'll demand more of them to support whatever repo activity or lending activity you're trying to sponsor. But in the final analysis, as long as the treasury bill has value in dollars, it'll serve as good collateral, right?
30 seconds. Martin's Place, Sydney, Australia, Macquarie Group. Do you still believe in the Pacific Rim expansion?
Oh, I don't necessarily believe in the China expansion. Long term and structurally, I mean, yes, China's undergoing a nice recovery these days. It's hindered somewhat by the slowdown in demand coming out of Europe and the U.S., but domestic demand in China is good, and that's enough to keep China's engine moving forward for another year. Beyond that, structurally speaking, you have a demographic problem in China. You have the demise of globalization. These are the things that are going to slow the Asia-Pacific story beyond this year.
Weak PMI early this week. Surprised to see it. Terry Wiseman, thank you.
My pleasure,
Smart
Jonathan.
stuff at Macquarie. Smart stuff. We'll get you back to talk about the debt ceiling because that was actually an interesting conversation, Tom, relative to the other conversations
about. Talk with Terry, you get an interesting conversation with me, you get nothing. I understand.
Do you need some love?
No, well, I'm going to get it next from Aston Martin.
Very cool. Mike Crack coming up next. Aston Martin F1 team principal, and I promise you this time, he's coming up next from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden has invited top congressional leaders for a meeting on the debt limit next week. Now, it comes after the Treasury Department warned the nation risked default as early as June 1st. The White House has said it would not negotiate with Republicans over extending the debt ceiling. House Speaker Kevin McCarthy, who passed a debt plan last week, said he would not increase the spending limit without cuts to the federal budget. A top U.S. regulator wants a sweeping overhaul of deposit insurance. Recent bank failures have partly drained a pool of money the government uses to protect banks' clients. The FDIC says that switching to a targeted coverage approach, where business accounts get more coverage than the current cap, would be the best option. That will require Congress to act. More job cuts on the way at Morgan Stanley in the midst of a deal-making slump. Bloomberg's learned that senior managers are discussing plans to eliminate about 3,000 jobs by the end of this quarter. Morgan Stanley has about 82,000 employees. Many of the cuts are expected to take place in the banking and trading group. BP is slowing the pace of share buybacks. The UK-based energy giant posted first quarter profit that beat estimates. But the surplus cash flow it uses to boost investor returns shrank by about 40%. BP says it will repurchase $1.75 billion of shares before announcing second quarter results. Now that's down by $1 billion from the previous period. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Fernando is a fantastic driver. He's, one of the best of all time, and he's finally got himself in a competitive car. And at 41 years of age, he's giving all the 40-somethings something to root for. He's going to be a competitive, driver and team this year for us, and we've got to, very much keep an eye on them because I think they could be the dark horse of this championship.
Big time. Fantastic to catch up with Christian Horner, the Red Bull Racing team principal, speaking to us about a month or so ago on the threat posed by Aston Martin in Formula One this season. Tom, to see them second in the Constructors' World Championship in F1 has just been absolutely phenomenal. What a turnaround for that franchise.
And for those that are learning like I am after watching Netflix and America Climbs on Board this, John, what I find is so important here is how small the group is. There's 20 drivers, there's, 10 teams, whatever. David Ricciardo they met Gala last night because he's not the official driver for the Red Bull team. He was there as the backup driver for Red Bull.
Daniel.
What do I know? Come on, Daniel Ricciardo. Mike's going to hang up. And the answer here is Aston Martin is on the up and up. That's my summary.
It's just great and wonderful to see Fernando Alonso doing what he's doing.
It is, and Alonso, of course, is picking up on this. This is some of the merchandising and imagery you see. We've got Alonso selling luggage while he's waiting to get a phone call from Taylor Swift. John mentioned that earlier, but Alonso's selling out the fancy Globetrotter luggage right now in London. Cool. And, you know, this is sort of the up and up, the branding of this around, you got to beat Red Bull.
Just amazing. Joining us now, I'm really pleased to say, is Mike Craig, the team principal for the Aston Martin F1 team. Mike, wonderful to have you with us on Bloomberg TV and Bloomberg Radio. I have to say, Mike, this wasn't what I was expecting last year when I heard the news that Sebastian Vettel was leaving and Fernando Alonso was stepping in. To see you second in the Constructors' Championship is quite something. Mike, what's led that turnaround for you and the team?
Well, to be honest with you, I did not expect that either, to make such a big step. But we tried to develop our car as much as we could last year, and during the year we made substantial progress. But it was never enough to pick the big points and move forward in the championship. So, yeah, by the end of the year, the car was in a much, much better place and we were much more competitive. And we took another step over the winter. And because everything is relative in this sport, it could also be that some other competitors have not made the step that they wanted. And it brought us to the place we are in now. And yeah, we are quite happy to be there.
Mike, we'll get to the business of all of this in just a moment. Can you tell me how important it's been to bring Dan Fallows, the technical director, on board to Aston Martin F1?
Yeah, Dan is one of many recruits that we had lately, all across last year. And they have been very, very complementary to great workforce that we were already having. So all in all, I think they came together as a great group, get all the strength out of everybody. And you see the result on track finally.
I look, Mike, at the extraordinary original that each race is different. In American baseball, we compare Fenway to Chavez Ravine and other baseball parks. The distance from Baku to Miami in terms of the actual track is just extraordinary to me. How much is the adjustment for you in, 10 days to go from Azerbaijan to Florida?
Well, it is first of all, it's a huge logistics effort to bring the whole circus over to the US, but in that short time, then you have to adjust basically everything, not only the clocks, but you have to bring the cars, adapt the cars to the layout of the Miami circuit because it's substantially different. And then we need to get used to the temperatures, to the heat, and all the things that are different. So it's quite a substantial exercise for everybody.
You know, I look at Red Bull as a leading team now, and the two drivers really going at it second by second, tenth of a second by tenth of a second. And the relationship of your two drivers is absolutely extraordinary. The veteran Alonso with Stroll, and granted, I get the idea that Dad's helping out as well, but Stroll seems like he's really earned his stripes. Explain the relationship of your two drivers as they go into Miami.
Well, they are, first of all, they are great drivers, but then also they are great human beings, very mature and great teammates. And they help us big time to work as a team much more than other teams do. Very often, and you see it with other teams, there is a fierce rivalry between teams and teammates, which at times is even ending in accidents at the circuit between these two cars. I think we are fortunate to have two such great drivers that have understood that this is a team sport and that the rivals are out there with the different colored cars than ours, and we need together at every possible opportunity to do better than the others.
Mike, I have to be honest with you, and this is my perspective, the Miami racetrack looks absolutely terrible. And Mike, I've got to say, and maybe you've got to be more diplomatic because of the position you're in, I think there's a worry for long-term fans of this sport that the emphasis is on breaking the United States of America, and they're willing to sacrifice the quality of the racing to do so. Mike, do you share those concerns?
No, I do not share these concerns because I think the racetrack in Miami has everything that is that a normal modern Formula One racetrack has to have. It has straights with DRS zones. It has high-speed corners. It has some low-speed corners. It has been completely resurfaced, and I think the heat that we will have over the weekend will add a lot of difficulty to cool the cars, but mainly to also keep the tire management under control. So all in all, I think we are up for a great weekend with great racing.
Well, clearly the future's bright for the sport. The attention it's got off the back of the Netflix series has just been absolutely phenomenal. To get my partner in crime, Tom Keane, on board to focus on F1 has been a pleasure for me over the last 12 months or so. Mike, I want to talk about things further down the road. There's always been a relationship between the F1 team and the road car. Ferrari's a great example of that over the years. More recently, Aston Martin again, talking about the same thing. I want to understand the tension 10 years out. When Aston Martin and the road car is fully electrified by 2030, say, where does that leave Aston Martin F1 and the relationship between the F1 team and what goes into the road car?
Well, that is a very good question, and the same applies also to all the other brands, the one that you were just mentioning. I think F1 is currently working heavily into carbon net zero, into going more sustainable by 2030, which is much less than in 10 years' time. So by 2026, we will run only on sustainable fuel. We will substantially increase the amount of electric power that we will deliver to the car. It will be around 50-50. So the Formula 1 cars are already hybrids, but the electric part will increase, and it will complement the road car fleet by these developments.
How will that take place if you're going to retain to some degree the internal combustion engine and the road car won't?
Well, I think lately the developments in artificial or how you call them, sustainable fuels is adding or is massively increasing life of the combustion engine, and it has been also classified like that. So from that point of view, I think Formula 1 can be a great participant or a great catalyst to the road car business, to make these nice cars that we have today sustainable and be able to run them for longer.
I sense from what you're saying, Mike, that you don't think F1 ever becomes fully electrified. And actually, to some degree, you can go some way to preserving the internal combustion engine on the road. Is that right?
Well, that's a good question. I think the combustion engine will have its time for the next 10 years for sure. But ultimately, it will fade out, and Formula 1 will not be with a combustion engine in say 20 years from now. I would doubt that.
Right. Mike, our reporters in London, they're like, okay, enough talk about Taylor Swift and the rest of it. What's the relationship with Honda going to be out to 2026? Are we going to see some drama as Honda tries to climb into Formula F1?
We are quite happy with the powertrain, power unit manufacturer that we have at the moment. We have a lot on our plate at the moment for 2023, 2024 to make further progress, and we are not really too much into 2026 at this stage.
Mike, just for the pit passes for Miami, 731 Lexington Avenue. Have you got the zip code?
Yeah.
You've got the zip code for Mike?
10022.
Okay.
Tell Alonso I'll buy the Globetrotter luggage if you can get us into the pits.
Mike, thanks for this. I appreciate it, mate.
We could be there with Taylor.
Good luck for the weekend. We're not going to ask about Taylor.
No, we're not going to ask about
Mike
Taylor.
Craig.
Thank you very much.
Of Aston Martin F1. Mike, thank you. What a pleasure. Looking forward to the race this weekend.
This is fun.
It's a good time, right?
You got a lot of emails, and people worldwide are just geared up for this thing.
Back to markets in the next hour.
Yes.
Anne Maletti of Allspring Global Investments. That conversation just around the corner. Your equity market negative 0.15%. From New York, this is Bloomberg.
Fascinating entrepreneurs, because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I mean, I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
I don't think the economy is that bad. I think it's very specific portions of the market, which have problems.
I do think that the Fed is likely to go ahead and hike later this week.
The Fed should have paused a while ago. The Fed will be cutting and should be cutting.
The risk is greater that they move too far, too fast, as they have.
The hope is that if there is a downturn, it'll be short and shallow, but no guarantees in that regard.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Welcome on radio and television. And a most interesting set of days ahead. Apple earnings out there, and before that, a Fed meeting tomorrow. Today, is there a bank reorg today, John? There's not another bank to go down.
Well, there's some job cuts. Morgan Stanley planning 3,000 more of them to go. Clearly, investment banking's tough. Deal making's difficult. We can see that.
Let's do that there. And to me, John, and frankly, this is going to go to the right sizing of First Republic like J.P. Morgan, is you right size. And the solution is in financial difficulties is you cut costs. And so there we are.
We've seen a lot of it. So let's talk about the difficulty right now for people trying to make a call on this Fed. I've seen so many headlines like that one. 3,000, Morgan Stanley, tens of thousands, pick a tech firm and put a number on at the end of it. What you haven't seen is that show up in the headline data in a major way.
Yeah.
So I've taken a first look at payrolls, which come out on Friday. Here's the median estimate in our survey so far, 180,000, down a bit from 236, but 180, Tom, with unemployment in and around 3.5%, still looks like a pretty decent jobs market, doesn't it?
I'm going to look at a 3-month moving average on that, and the answer is it's still way above. And what's interesting is the economists that calculate the optimal non-farm payrolls, it's a shockingly low number. It used to be 150, and it's come down over the years. Some people are even under 100,000. So they look at NFP or some of the other data, and they just say this is a boom labor economy.
So the Fed's committed to 25. What will they commit to next? Overwhelmingly, the consensus view is they won't commit to anything. It'll be a conditional pause. My question would be, okay, if they communicate a so-called conditional pause, is the bar higher for a cut or another hike? Which one?
You and Brammo can dive into this all you want. I'm just going to go with the economic data. And frankly, there's a lot of economic data, including today. I mean, I don't think we can make light of, is it the frontline data? No. Durable goods, JOLTS survey today. I mean, they matter to this debate. And, again, John, ISM, you believe in, May 3rd here, ISM coming up by ISM Services.
ISM manufacturing rocked this market yesterday.
Yeah.
Prices paid rebounding, shooting yields higher. Saw the same thing off the back of the Meta bond issuance. Had a lot of bond issuance yesterday from the corporate side of things, really pushing yields higher across the curve yesterday, Tom.
I predicted it, and I've also said you're going to see a great zombie roll-up, 4.14% to get our two-year yield going.
Let's get you through the week. Federal Reserve tomorrow, ECB Thursday, payrolls Friday, Apple earnings after the close on Thursday. Going into all of that, equity futures right now, negative 0.2% on the S&P 500. Equity's just a bit softer here. Yields just a little bit lower, down 3 basis points. The 10-year still in and around 350 as it has been for the last several weeks or so. And to look at the euro, still sub 110, 109.67. I make that 1, 2, 3, I think 4 days of weakness now on the euro side of things against the dollar, Tom. Just backing away a little bit from the year-to-date intraday highs that we printed just last week.
And quickly and distant, the yen backs away. We talked to Elsa Lignos about that, and I'm sorry, I'm always bringing yen dynamics into a global and indeed an American analysis, and you're really beginning to see some standard deviation jumps here of weaker yen, and I just would suggest don't ignore that.
You know what's not weak? The Aussie. Aussie is strong this morning off the back of a surprise 25 basis point hike, some indication they might go again.
Right.
And clearly some indication also that they're willing to tolerate some growth weakness to get inflation down.
Thierry Weissman of Macquarie Group, Sydney, Australia, making clear, at least in the short term, China's got some oomph there as well. This is a joy this morning to drive the conversation forward. And if you are institutional or retail Wall Street and you are looking at your value portfolio underperforming, this is the conversation of the day. No question about that. Amelotti is iconic. It's strong of Milwaukee. It is part of Allspring Global Investments, and she's head of active equity right now. State the value case over the growthiness of big tech.
Well, Tom, I do think that, values had a little bit of a run last year, and you saw the reemergence of growth this year. Not surprising, right? Because you saw interest rate contraction a little bit, and that multiple contraction you saw in growth stocks reemerged this year and gave some of that back. Plus, fundamentals of those big tech names looked better than people expected. And so you saw those big tech names do better. However, valuation of those big tech names now is a little frothy. And I think the risk reward is not as favorable as it looked in the beginning of the year.
Your claim, good or bad, is to find the value trap and ignore it. Where is the value trap right now?
I think the value trap in the market right now is low quality. It is not paying attention to fundamentals and just throwing darts, owning everything. That's a value trap today. You cannot own an index in an environment where rates are going up, inflation is still high, and the economy is clearly weakening. Now is the time where you really have to be selective.
Crisis. Mohamed Al-Iran came on this program several Fridays ago. I think we're at the IMF World Bank Spring meetings in Washington. He said this is not a banking crisis. You say it is. Why is this a regional banking crisis?
I don't think we haven't seen the end yet. I don't believe we have. And look, I heard other people on your show this morning say it is. Things typically don't end as quietly as they have. You don't see a big fraud like FTX. You don't see regional banking crises as 3 banks collapse, and then just everything settle out. There's too much noise there's going to be something else. Is it going to be another regional bank, or is it going to be something else? That I don't know for sure, but we do know, commercial real estate, specifically office real estate, is held by a lot of regional banks, and that is problematic. But again, I do think there's been so much noise in that, or so much talk in that space, that's been pretty well telegraphed, or the worst kept secret maybe. I really fear more about what others aren't talking about, maybe even what I don't know. I should be worried about today. There's likely to be another surprise out there.
So I'm going to take all my money, put it in a money market fund, and pick up 4% plus maybe and hide. I imagine that's not what you're advocating investors should be doing. So what are you telling them?
Yeah, that old adage of sell in May and go away, not a big believer in. And here's why, Jonathan. I don't have that crystal ball. I don't think anyone coming into your studio has the crystal ball of really knowing what's going to happen.
Some are good at pretending.
Yeah, some are. But the reality is if you sell today, you have to be good at two things. You have to be good at timing on the way out, and you have to be good at timing on the way in. That's not what I've been good at my whole career. I think that's not what I'm paid to do. That's not what good investors do. What good investors do is select the right companies and stay invested in those companies throughout the cycle. And I think history has shown you get rewarded for doing that.
On an active basis, which you've led in, and you had a great year last year, and 3 years, 5 years is really challenging to say the least. On an active basis, do you have to hold fewer holdings now? Do you have to tilt towards Sequoia, acclaimed Fidelity 50, Joe Mircino at Fidelity 50 years ago, and what you did at Strong? Do you have to hold fewer items now?
I do think you want to be, I do think you own fewer names. I don't think you want to be so concentrated that you bring a lot of risk to the table. So, what is the right number of names? Is it 50? Is it 100? It's
well, your top 10 holdings on large cap is 44%.
Yeah.
Is in the top 10.
I mean, in large cap, I think you have to be a little bit careful, because if you look at the indexes, the indexes carry so much weight in the top 10, right? And the indexes are the enemy. And so you have to be, competing with the enemy for large cap. But if you look at, the mid cap, the small cap space, 75 to 120 names, maybe that's kind of the better average to think about. Large cap, you can be a little bit more narrow than that, but you still need to be diversified in the number of names you own in a portfolio. As an investor, you want to be diversified across what you own. And maybe we should talk about some of the things that I do like in the equity space.
I've tried.
Yeah.
What do you like?
I know, it's hard.
Typical Milady taking over the interview.
Sorry.
What do you like?
It is hard. I know I've been pretty pessimistic. I do think there are some places, healthcare is an area that has underperformed, and it has been an area that really hasn't recovered that well post-COVID. It's held back, but there's a lot of room in the med tech space and the healthcare services space, and the multiples really haven't recovered there. So, Tom, if you want to talk value, right, there's some value there and some good long-term growth potential. I do think emerging markets also look quite interesting, and there are some emerging markets where, rates rocketed it much higher than they did in the U.S., and they're on the other side. They're starting to come down, and so they're ahead of where we are in this cycle, and the dollar's also starting to show some weakness. We all know that if you look at the dollar versus emerging markets, when the dollar weakens, that's typically good for emerging markets, and so that could be an interesting area for investors.
Some of those countries were the true front loaders. Do you want to talk F1? Do you want to talk Formula 1?
Well, you guys are the experts, clearly.
Hey.
Oh, yeah, you're looking at me.
You've been really fast and loose now with experts.
It was great.
And thank you.
Yes, thank you so much.
Thank you. Anne Milady there of Allspring Global Investments.
I can see her
You're an
Las
expert
Vegas.
now.
I can see her,
Do you want to go to Miami or Vegas?
No, she's like you. She thinks Miami's sort of like, no, that's not classic.
I just think
you go to Vegas.
There's a risk they...
What's a ticket in Vegas? I mean, Milady's got to be in the pit. It's got to be 10 grand just to stand there.
I've said this. I said this last time when we caught up with Kristen Horner of Red Bull. Sometimes you'd probably be better off flying to Europe and buying a race ticket to one of the
I think
tracks
we should
there
do that.
than trying to go to Miami or
Monaco?
Vegas.
You and me in Monaco with the Bramo?
Pretty pricey. I'm thinking more Silverstone.
Okay, that's like in England, right?
We'll fly into London and we'll go up north, Tom. Except it's not really that far north.
It's just outside the Watford Gap.
Something like that, yeah.
Nailed it.
Henry Trace of Vader Partners joining us shortly on the debt limit in Washington. And thank you, it's good to see you. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden has set a high-stakes meeting for next week on the debt limit. The Treasury Department warned that a potential default could come sooner than expected. The president will meet with congressional leaders. Republican Kevin McCarthy, the House Speaker, has said he won't extend the debt limit unless there are trillions in cuts to the federal budget. Underlying inflation in the euro area slowed for the first time in 10 months. After stripping out volatile items like food and fuel, consumer prices rose 5.6% from a year ago in April. That backs the case for the European Central Bank to slow its most aggressive interest rate hiking campaign ever later this week. The White House National Security Council says Russia has suffered more than 100,000 casualties since December in the fight over Bakhmut in eastern Ukraine. That includes 20,000 dead. The commander of Ukraine's ground forces says they have pushed back Russian troops from some positions in Bakhmut. Pfizer beat first quarter estimates thanks to persistent demand for its pandemic products. Still, the drug maker's COVID vaccine and antiviral face pressure at a time when infections are waning. Those two transformed Pfizer, contributing more than half of the company's $100 billion in revenue last year. But sales of the vaccine fell 77% in the first quarter. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
News breaks. No one covers the world like Bloomberg.
It would be, of course, a total disaster for Emmanuel Macron because he's been elected on this reform and he would have to basically start from scratch.
It definitely is an exciting day for Apple. First store in India, here in downtown Mumbai, a second one coming up in Delhi.
TK, we've got a lot to talk about.
Debt, China, and the shockingly cautious view the IMF has on the view 5 years forward.
Bloomberg, your global business authority. Everyone's looking for another rate hike.
They're going to be looking at the momentum of the economy.
It's not too hot, not too cold. The Fed's kind of stuck in the middle.
But will they signal a pause?
A dovish hike would ease financial conditions. A hawkish hike could destabilize things.
The parlor game of the American economy.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Uncertainty has gone up. Uncertainty has gone up a lot.
The Fed's goal is not to send the economy into a deep freeze.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
Examples of a debt ceiling crisis in the past before, and they have found resolution. I actually think that we may come down to the wire. I think we may approach a crisis, but I think the cleaner solution here if we don't get to a political resolution, is simply for the U.S. Treasury to continue to do what it's doing, i.e., issue debt.
A different perspective there from Terry Wiseman, the global currency and interest rate strategist over at Macquarie, a little bit early this morning on the debt ceiling debate, following the wake-up call from Janet Yellen, the Treasury Secretary, just yesterday, writing in a letter to congressional leadership the following: our best estimate is that we will be unable to continue to satisfy all of the government's obligations by early June, potentially as early as June 1. We now know there will be a scheduled meeting on May 9th between congressional leaders and the President of the United States. The President orchestrated that meeting just yesterday, May 9th, a week from today. Before we get there, got a Federal Reserve decision tomorrow. The two-day meeting begins today. We've got payrolls on Friday. I offered the estimate on payrolls for you a little bit earlier. If you'd like that again, it looks a little something like this, Tom. Close to, but just below 200K seems to be the estimate at the moment going into Friday.
And what are the revisions? I mean, I can't remember. I believe 3 months moving average is 1 million jobs were formed over 90 days, 333,000, whatever the number is. Yes, we're coming down, but do we really believe in a collapse in the job market in America? To me, I don't hear that many people saying that.
180,000 does not scream collapse in the labour market. Jobless claims at 240 does not scream collapse in the labour market, and 240 is the estimate for Thursday morning for jobless claims, just up from 230.
We haven't talked about it on a Tuesday, but I'm more interested in the real estate market, the commercial real estate market. I think a number of smart people have said, you know, this is something that bears immediate scrutiny into the summer.
I agree. Take a look at the KRE, Tom. Regional Banking ETF. Have a look at what it did yesterday. Yesterday, down by 2.8%. Even with
JP Morgan
precisely,
precisely.
They can't get a lift.
Some terrific work again today. I really want to convey to you with Bloomberg Opinion. Matt Levine and John Authors, absolutely brilliant on JPM FRC. Look for that today. Henrietta Trey is now with us, Economic Policy Research Director, Veda Partners, with great experience on the marble halls of Capitol Hill. When there is a debt crisis, when there is some form of shutdown or jawboning, how does the budget process change on Capitol Hill?
I think, if anything, it speeds up. It speeds up dramatically. There was a lot of hay made about Secretary Yellen moving the date for the debt ceiling up from June 5th to as early as June 1st yesterday. But the reality is that nobody does anything until the last minute anyway.
Right.
We've got about 4 weeks to get this resolved. If those 4 weeks are in May or June or July or even September, it's not like they're going to start working in advance. I think Speaker McCarthy demonstrated a lot of goodwill by putting that vote on the floor last week, getting things moving well ahead of schedule, even before Secretary Yellen provided the update post-tax receipts. So basically, it just spurs them into action. We've got 4 weeks to get this resolved. That's plenty of time. We've seen it done in far less. And in fact, I would wager that it won't even start to come to an end until the week of the 22nd.
So based on that answer, 5 guys sitting on a couch with Chair Yellen in the Oval Office on May 9th doesn't have an urgency to it? Is that what I hear?
I'm happy for the Big Four to get in a room. I think that's very important. That is one of the steps in the process. But we have a number of other formalities that also need to be accomplished. Senator Schumer, the majority leader, has scheduled 2 votes in the Senate, or queued them up at least. One on a clean debt ceiling hike, with all the Democrats will vote for, and then one on the House passed bill, which some of the Republicans might vote for. So we're still at least a week away from any concrete negotiations. I want to see some of the budget committee chairs get called up. I imagine that there will be more than just this one group of Big Four that gets called up to the White House. And then, of course, we really want to see staff in the room. You guys know this about me, and so do all of our clients. I really care what staff has to say more than anything else. So I want to see those guys get together, and I would imagine that starts soon, and they're able to cobble together a deal within the next 3 weeks.
Let's tease that out a little bit more. Henrietta, I don't have a read on this. I've got no idea which way it goes. I'm told by some people it's the same movie, same ending, won't be any different this time around. I'm told by other people it is different this time. Henrietta, what informs your read on that? You mentioned staff. Walk me through it.
Right. Well, not only have we seen this movie so many times before, but it's almost an exact repeat of 2011. You can even find similar votes from 2014 and 2017. We have the exact same dynamic where the president is a Democrat, the Senate is controlled by Democrats, and the House is controlled by Republicans. What ends up happening is you see a bill passed in the House that's written mostly with the intention of just getting the majority party in one chamber signed on. That's what they did last week. And now we're going to start moving into the place where staff goes through the fine print and finds $300 to $500 billion in deficit reduction, which is the level that staff advises me on the Democratic side they're willing to swallow in order to hike the debt ceiling to $33 trillion, which would get us roughly through, call it March of 2025, after the presidential election cycle. Those are the kind of minutia points that staff is focused on. And you see those cuts come from things like clawing back COVID relief, reducing service on the debt, fraud, waste, and abuse spending, all things that were incorporated as a part of the Republican passed bill, but not nearly the $3 trillion plus number that Speaker McCarthy put on the floor. That's a non-starter. We need to get that down to $300 to $500 billion and horse trade back and forth. And that's what staff will do behind the scenes.
There's going to be a lot of ink wasted on a lot of analysis between now and then. Henrietta, indulge me and go through this scenario. This is something Terry Wiseman of Macquarie mentioned in the last hour. He said this, and this is a quote from him. If we approach a crisis, I think the cleanest solution here, if we don't get to a political solution, is simply for the US Treasury to continue to do what it's doing, i.e. issue debt. Henrietta, he made the point that they can just go on, ignore the political situation and carry on issuing debt and pay their bills. Is that something that you can see as a workable solution to this?
No, no offense, but it's just not. Congress is going to insist on acting here. I know it looks like they don't want to take a vote, but they react very poorly when any federal agency or otherwise takes some of their authority away. That jurisdictional control is something that you see committees covet, and certainly the House and Senate. Look no further than Ways and Means for their tax policy bills, getting blue slipped, insisting that they start in the House. They react very poorly when any federal regulator oversteps their bounds and usurps their authority. So I believe Congress will act. I am not concerned about whether they will act. Default is not an option. I think investors should, sort of skip over the headlines and see that Kevin McCarthy put that bill on the floor well before he needed to. We've got 4 weeks to negotiate. I see no real problem here.
4 weeks is enough, as far as you're concerned.
More than enough.
Henrietta Trace of Vader Partners. Constructive view on things working out in Washington.
And what's great about that, and it's sort of like the Dr. Weissman's expertise and the economics of it, is she's just in the trenches experience. It's like actually talking to people that have been through this before. How quaint.
We're going to talk to some people who have been through this before in the next hour on Bloomberg TV. Megan Swiber of Bank of American Securities, Tony Rodriguez of Nuveen, Daryl Cronk of Wells Fargo. We've been having so much fun, Tom.
Yeah, I know.
Time's almost up, yeah.
I mean, we can, do more Formula One talking.
What would you like to say about F1?
Out on Twitter, Autosport, with a really important thing is they went into turn 1 at Baku, and I remember when Verstappen passed the Ferrari guy, he was flying. And they just quantified it. He was going 30 kilometers per hour faster.
So one thing that we didn't get to...
I was stunned.
With Mike Crack of Aston Martin, that DRS thing is a cheat mode down the straight.
Yeah.
Baku. I think it's...
Explain what DRS is to those ignorant.
Rear wing opens up, less drag, go faster down the straight.
It's like a turbo thing.
It makes the cars go faster.
Yeah, okay, I'm trying,
Let's put it that way.
With me.
Makes the cars go faster.
Yeah.
And on a Red Bull, it means the car is going much, much faster.
You could see
down the straight.
the difference in speed.
It's like being on a computer game and hitting a cheat button and watching the car go that much quicker.
And in Miami, I would assume it's a bigger deal there even.
It's meant to make the racing more exciting to increase the amount of takeovers we see, but ultimately, I don't see much driver skill in that, do you?
No, I don't, but would you get rid of it?
At all. I don't know what the solution is, but I think it's become a little bit more of a problem at some tracks.
They're good. Thank you for your response.
They need to introduce the window
this.
for it or something like that. I think they tried that in Baku, but maybe they need to do it.
That's great. Anna Letty's into it. Anna Hahn loves it.
We're kind of thinking out loud about stuff we don't know about.
Yeah,
that's the show, right?
That's how we invented this, folks.
From New York, this is Bloomberg.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year, and we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
Bloomberg Surveillance on radio and television. Thank you for joining. Lisa Abramowitz is off today, still recovering from the White House Correspondents' Dinner. And John Farrell preparing for the 9 o'clock hour of an eventful Tuesday into the rest of the week. We're going to get briefed by Claudia Sahm, one of our most popular guests here. She's got some real belief on what the Fed will not do into this year, in the following meetings into 2024. But right now, Michael McKee with us, and we pause because McKee doesn't have to look down at his computer screen and digest 12 pages of material in 32 seconds. It's a pause here. And let's start, Mike, with at 10 a.m. this morning, you lectured me once, hey, stupid, pay attention to the JOLT survey. What does the JOLT survey tell Jerome Powell this morning at 10 a.m.?
I was just delivering the message from Jerome Powell to you. The JOLT survey is kind of what they hung the idea of tight labor market on. The number of job openings was so great by a magnitude of factor that it had to indicate that there was a shortage of workers, and that was leading employers to bid up their pay in order to get them to come back to work. And so a drop in JOLTS, which we did see in the last prior month that was reported on it, is considered good news. So we're looking for a bit of a drop today in terms of numbers. Now, I have to also caution that the JOLTS report is not seen as widely accurate, that there may be a lot of duplication in it. There's a very low response rate from companies to this, but it's one of those things that we have it, so people look at it.
Let's go to the Fed meeting. Tomorrow you will be there. You will be asking questions. Always, Mike McKee is down later. We were making a joke earlier in the show that Colby Smith of the FT will probably get the first question, and then the chairman will read whatever the rude question is off of a prepared statement. Who makes that statement for him? Is he there writing it with a kid at his desk with his Bloombergs in front of him?
He is working with the staff there to anticipate the questions we might ask.
Which is the question that matters now written out? Well,
there's a couple of them. The biggest question is going to be how they sell the idea of staying at 5.25% for a lengthy period of time. Will there be any kind of circumstances under which they would think about cutting rates, because that's what the market thinks they're going to do? And if the market thinks that, does that mean that the Fed has a problem with A, credibility, and B, financial conditions?
Have we ever been here? Have all the other chairmen of our youth and onto our middle age, have they had to define pause dynamics before?
They have. It has always been a question that comes up when they get to the end of a tightening cycle. And generally, it's going to be interesting to see the statement, because generally they don't say it's the end of a tightening cycle. They say, we think we are close, and we might have to do some more, but that'll depend on incoming data. And I suspect you'll get the same thing again in case we see some inflation data pop up.
The inflation data, I mean, that's the issue at hand right now. Where is the inflation rate in Jerome Powell's head? Which is the statistic, and what is that level of inflation he's looking at right now?
Well, they're still looking at over 4% on the PCE, which is the target they choose, the index that they choose to do their targeting. Their feeling is they're going to get down into 3 to 3.5 by the end of the year, when rents start to show the decline that have been priced in advance because of the statistical way they collect all this. It's been a slow process to get rents down, but you should be able to take a good portion of it out.
Right, that's good, Mike. There's some Boston Bruins swag. It's on sale today if you're looking for that on your trip down to Washington.
I got a note from my brother yesterday that said it was perhaps the worst defeat in hockey history. So
yes, I would. I think it's a big shock, to say the least.
I would point out that the Red Sox are not in last place, so this is good news.
Things can move forward. Michael McKee, thank you so much. And of course, anticipated our Fed coverage tomorrow, including Michael McKee in Washington with the chairman. Right now, and this is really important, a conversation with Claudia Sahm, who was on fire yesterday on Twitter. She's a former Fed economist out of Michigan, Sahm Consulting, and also, of course, writing occasionally for Bloomberg Opinion when she chooses to. Claudia, I'm going to cut to the chase. You are pivotless. This is not a Fed that will pivot. Why is that? Why will the Fed just say no?
Well, there's a lot of reasons why, as we go later into the year, the Fed will not cut. They will not cut if there is a recession. They will not cut if there is banking turmoil or financial market turmoil. I mean, we've seen this twice. They're going to hike tomorrow, and that'll be twice after bank failures. And the lesson from the past is that if you go back to the Arthur Burns, who is widely viewed within the Fed as the worst central banker in the history of the Fed, he kept cutting when unemployment went up. And that led to Volcker having to stay the course in a severe recession. This Fed does not want that. That's not how they're going to justify it. They're going to talk about the natural rate, R star, all that good stuff. But the history looms large in the Fed, and it kind of makes sense, too.
Within that, they have time, and there's a sequence of meetings out every 6 weeks or so. I would suggest they have massive asymmetric advantage to waiting and seeing more data. Is that how you read it?
They may have an advantage. I'm not sure all of us do. Right? The Federal Reserve has become data dependent in almost a backward looking way. They know full well that inflation takes time to come down. There is a lot in the pipeline. If they don't start looking forward with their decisions, it's going to be too much. That might not show up this year, but they're playing with fire here in terms of pushing and pushing when we already have a lot in the pipeline.
I want to go to your Michigan economics, and one of the ideas, the soul, if you will, Ned Gramlich and all of Michigan economics, is the partitions of American society. What percentage of America right now is in recession?
Well, this is a really interesting point. When we're going to get the data on Friday for, say, the labor market or the JOLTS today, these are national data. They mask a lot of what's going on under the hood, both in terms of individuals and groups of individuals, also parts of the country. There's over 40% of the states in the United States that haven't made a full recovery in employment. We don't talk about that. So there are a lot of differences in terms of where the recovery is and in terms of where a recession would hit hardest.
And I would suggest, I don't want to get into a stagflation discussion. I'll let David Weston do that with Professor Summers. But the idea, Claudia, of celebrating 1% GDP, that just doesn't get it done, I would suggest, for half of America. Am I right on that?
I think you're right. GDP is a pretty abstract concept. I still look most to the unemployment rate and to jobs. That's what means the most to Americans. And it's low, right? And remember, that 1% GDP, a lot of that is inventories. We see consumers still spending. That's what we want to see, is people being able to get what they need.
Well, let's go, Claudia Sahm, to the job economy then. And to me, what is so important here is the decile make of it. We all know the charts that show the bottom decile, the bottom quintile has really been doing well. What about the broad middle class and the COVID recovery?
We're doing well. I mean, this has been a bottom-up recovery. That owes to a lot of things. And above all, right now, a very strong labor market. The top of the top, their income, their wealth is not as dependent on jobs as basically everybody else. And so we've seen a lot of progress. Unfortunately, inflation has eaten away at that. And yet there is progress in jobs. And it is true, we have done a lot to close some of the gaps at the bottom. And that is truly something to celebrate and to keep, to really try to protect.
Neil Dutta of Renaissance sent me a blistering note yesterday underscoring his optimism on the consumer, his optimism on good incomes, if not great incomes as well. Is there a great misjudgment, beginning with the IMF, but is there a great misjudgment about the resiliency of the American economy here?
Yeah, so I have full faith in the American consumer and American workers. Like, they'll put it in and be able to spend. People need a lot of the spending by Americans that are items and services that they need. So if they got the income, they'll spend it. Where I have maybe less full faith is in what's happening in Congress and at the Federal Reserve. Anything that looks like a debt ceiling debacle or federal debt default, that would just be disastrous, and we don't need that right now.
Okay, I get that. John and I have been going back and forth on this, and I'm old school on it, folks. It's going to get solved. Are you telling me they're not capable of moving the can down the road?
I'm not sure they take it seriously enough. Honestly, what was put through the House by Republicans, that's not a serious start, and we have a month. Your prior guest gave me quite a bit of hope. I haven't worked inside the halls of Congress, and yet this is not the time to be playing with fire. And the economy, while I agree with Neil, there's a lot that's good in what's happening right now, and I think there's probably too much pessimism. We are in a fragile place. That's a lot to withstand.
Well, I'm looking at short-term rates, and maybe it's outside your purview, but I'm going to go there right now because I got to get one more question in here. And the fact is, old school 3-month LIBOR just climbs and climbs and climbs up as well, including more recent 3-month or even inside 3-month measurements as well. How do you, as an economist, interpret the stunning rise in short-term yield?
Again, I think that fits with this degree of pessimism. I have a hard time, what markets are predicting, which is reflected in the prices, I have a hard time squaring. I very much disagree, as we talked about before, that the Federal Reserve is going to start cutting later in the year. I think we could have a recession. I think that, I agree with that, but I think there's way more pessimism in place. So things are, and a lot of that then is in their views about the debt ceiling, and there's just a lot going on. So frankly, I think it's harder than usual to parse out what markets are doing.
Dr. Sam, thank you so much. Claudia Sam with us with Sam Consulting, writing for Bloomberg Opinion and far more. She came out of school and she has her own ratio, her own index statistic with the Federal Reserve Bank of St. Louis, keeping score in the SAM index having to do with our labor dynamics. Let me give you a data check here, and I'm going to call it odd here, because after what we've seen with J.P. Morgan and First Republic Bank, we got to get back to the correlative forces out there. I think John's right, 4.13% in the 2-year yield, elevated over the last number of weeks, not with a breakout yet. 60 basis points of curve inversion. The real yield gets noticed, 1.31% on the 10-year real yield. Futures -8, Dow futures -85, and the VIX still remarkably solid, not 15, but a 16.60 on the VIX is of note as well. Hey, Bitcoin, 28,000. Stay with us on radio and television. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden has invited top congressional leaders for a meeting on the debt limit next week. It comes after the Treasury Department warned the nation risked default as early as June 1st. The White House said it would not negotiate with Republicans over extending the debt ceiling. House Speaker Kevin McCarthy, who passed a debt plan last week, said he would not increase the spending limit without cuts to the federal budget. A top U.S. regulator wants a sweeping overhaul of deposit insurance. Recent bank failures have partly drained a pool of money the government uses to protect banks' clients. The FDIC says that switching to a targeted coverage approach, where business accounts get more coverage than the current cap, would be the best option. That will require Congress to act. More job cuts on the way at Morgan Stanley in the midst of a deal-making slump. Bloomberg's learned that senior managers are discussing plans to eliminate about 3,000 jobs by the end of this quarter. Morgan Stanley has about 82,000 employees. Now, many of the cuts are expected to take place in the banking and the trading group. Shares of Chegg are plunging. The company warned that the ChatGPT tool is threatening growth of its homework help services. Now, Chegg makes much of its money in subscriptions, and that's a revenue source that's in jeopardy if students see AI chatbots as an alternative to paying. And the one-time high-flying Vice Media is preparing to file for bankruptcy. Bloomberg's learned that the online media company has been looking for a buyer. Well, now it's preparing for a possible bankruptcy filing in coming weeks. Now, Vice was once valued at $5.7 billion, and its investors included Disney and Fox. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This Fed raised rates much more than the forward guidance suggested. They put those rates way above where the market suggested last summer they were supposed to be, based on the inversion of the yield curve. In the banking system, the lending system doesn't work when you have a higher short rate versus the longer rate. Yield curve, not just as a predictor of recession, but causes recessions.
Joe Livornia, SMBC Group chief economist there, and he's been very dead on about the excesses of the Fed. That's been part of the debate. He's clearly been one of the crew looking for excesses there, and certainly we see within the debate this morning going to tomorrow's coverage, words will be carefully chosen by the chairman of the Fed. We'll have complete coverage for you on that tomorrow. Futures -8, Dow futures at -81. I'm going to call it a churn to the market. But I really want to point out that within this, the banking stocks need a recalibration today. I'm going to sell this to you as clearly as I can. Matthew Levine and John Authors of Bloomberg have written two brilliant essays, very different essays, but two brilliant essays of the historic moment. I don't think enough has been made of the second largest collapse of banking in our recent history, and Levine and authors absolutely kill it for Bloomberg Opinion this morning. That's required reading for Global Wall Street. Always a study for Global Wall Street is Christopher Verone, partner, head of technical and macro strategy at Strategas. It is a Baird company, and where Chris and I are in common ground is a beloved belief in the trend now. And as you said, Chris, as we were talking here before this moment, you're in search of trending. Trending's out there right now, and the cacophony is so great right now, there really isn't a trending to trend on.
Yeah, there's not much. I mean, when you look at the external trend of the market, I guess you could say generously it's up. But when you look under the surface, it's a mess. I mean, you only have 50% of the S&P above the 200-day moving average. Right. So you go sector by sector, group by group. There are names that you would expect to be behaving in a very similar way are acting remarkably disparate relative to each other.
Why is that?
When I think about what our estimates are for growth, both nominal and real, I don't think there's enough real growth for everything to work. I mean, good, durable, advancing bull markets, you'll get 80, 90% of issues involved. I mean, we're dealing with half the market on the field and half the market off the field. I think there's really no better evidence of that than a sector like discretionary, where it's about as split as I've ever seen in 10, 15, 20 years. You have things like autos very weak, yet home building very strong. You have retail awful, restaurants good. Very, very split.
On a log chart where you're looking at percent change, when you look at the big tech stocks that have outperformed, do they have technical veracity right now, or you just can't make a call?
I think they have veracity, but even tech, which I think is being confused as a very strong sector here, when you look under the surface of tech, it has the same problems that the broader market has.
It's got 7 stocks moving and everything else is not there.
In fact, under the surface, it's actually worse than the broader market. I think on balance, Tom, when you look at like yesterday's new low list, regionals, big banks, consumer finance, retail, metals and mining, steel, I mean, that's the handbook of what you don't want to own into a slowdown.
The heart of the matter here, folks, and this goes back to, we all read John Magee, written in the 1940s. Chris Verone and I got out to maybe the 6th edition. And, you know, I think of the Chartcraft people up in Larchmont and all. Those were normal times where you looked at 100, 200 stocks. Nobody's looking at 100 or 200 stocks right now, are they? I mean, it's basically been blown up.
Yeah, I think it's certainly been blown up, and the concentration of the market, particularly at the top, whether it's passive or whether it's ETF, certainly contributes to that. But let's go back to basics. Does the leadership of the market here look like economic growth is about to reaccelerate, or does it look like it's about to slow down? I would choose the latter here when you see the weakness in banks in particular, the weakness in autos, the weakness in steel.
Jane Fraser at the Milken Institute with Bloomberg made real clear, and granted, she's a public voice. She's got to say the right things. We all get that. It's like Jason Trennert is the same way. I mean, the guy's so large, he has to say the right things. So Jane's given the line, it's over, FRC is done. Thank you, Jamie, for taking him out. Baloney says a large body of people. What do your charts say about the recoverability of the different shades of regional banking?
Well, how about what the market says? Why can't the stocks rally? Where 5-6 weeks past the acute phase of this crisis, where 48 hours past the news of JPM and First Republic, and look what led on the downside yesterday. The regional banks were terrible. You have all of these either at or making new lows right now. So we asked the simple question, as we did in our work this morning, if the crisis is over, why can't the bank stocks rally? And it's not just the small communities and the regionals. Bank of America hasn't rallied here. PNC hasn't rallied here. KeyCorp hasn't rallied here.
Right.
It's a mess.
Okay, I'm going to give you a window, folks. We're going to go adult pro tech talk here. We can do that with Christopher Verone. And radio charts always work, so it really works out. I'm looking at the Keefe, Bruyette & Woods Bank Index, and I'm looking at a Wells Wilder 5-trend series of parabolic SAR, Kleiman exponential moving averages, and critically ADX DMI, which is a measurement of trend. I can't own this. What do you need to see where you can say I can buy the banks?
Well, I think at a minimum here, you have to reclaim some of the levels that you saw in early to mid-March.
Base building.
Are we there? Have we seen
no,
it?
But is base building 3 months or is base building a year? I guess that's the heart of the matter.
I think it's longer than that. I think it's 6 months plus.
Right.
And it's not just the banks. The consumer finance names are weak. Look at Capital One or Discover. The boutique investment banks, Evercore, Moelis, Lazard, are all on their lows. The asset managers, BlackRock, which should reflect the S&P, right? BlackRock is a top 3 holder of 99% of S&P stocks. It should look like the index. That's below the 200. So there's something sick within these financials. What that is, I think, will reveal itself over time. But to say that the financials are giving a endorsement message here, I think is a bit of a stretch.
I got 8 ways to go here, folks. And for Dennis Gartman watching this morning, I've got to go there. He's going to go lower right to lower left to the upper right on gold. Gold sustains at 2,000. Nobody's really talking about it. I don't hear it in the zeitgeist right now. What is the technical construction of a bar of gold?
I think it's fantastic. We try to talk about it every day. And, you know, gold's been a leader now for the better part of the last 6-7 months. It's the only time in recent history we can find where the S&P is more than 6 months off its low, but gold's up more. Gold's up about 20 over the last 6 months. Gold's up, S&P's up 15. This consolidation in gold prices the last few weeks has been so benign. Absolutely no technical damage done. Even as rates have pushed higher here again, the pause in gold, I think, looks orderly. Next move to us is higher.
How do you express gold? Is it through an ETF? Are you buying powder? Are you buying gold dust? What's the most efficient way?
Buying GLD. It's the closest play through paper we can get the physical. I'd be skeptical of some of the gold stocks here, just given the weakness in the metal and mining complex broadly. But the physical, I think, is the best way to play.
Okay, I got some distribution here at 2,000. I'm going to go all Luis Yamada on here and say, what's your vertical count off of gold hovering at 2,000? Is your framework 2,200, or can you go even higher?
So targets, I think, are a very precise objective in a very imprecise business. My target's higher. If you want a number, I can get you 2350. I think that's going to prove to be conservative. I like the asymmetric qualities gold presents here. I think on one hand, it may protect us against the bad outcome, hard landing, a deep recession. But on the other hand, I think it also works in an environment where the Fed goes back to old habits and prints money. So I like the very asymmetric qualities gold presents. I don't think I need to get the macro right to get gold right here.
What's the dollar say? We started with Elsa Lingos this morning out of RBC Capital Markets. I thought she was indeterministic about dollar trend as well. Do you detect a dollar trend now off BBDXY or DXY?
I mean, I think DXY, you have to remember, is mainly euro, right? So you're talking 60% euro. On balance, I think dollar trend is down. It is a little bit more disparate.
Is it tradable?
Gun to my head, we're going to get meaningfully lower dollar over the next 12 and 24. Dollar trend is down. It is a little bit more disparate.
Is it tradable?
Gun to my head, we're going to get meaningfully lower dollar over the next 12 and 24 months. Right here, I'm not convinced. There's, I mean, we look at dollar yen, you look at dollar Aussie over the last 24 hours. You can make the case for a mean reverting move here. I think the overall trend in USD is down.
Jason emails in here from a cigar store in Midtown Manhattan and says, what's your single best buy? Do you have an individual stock that needs to be acquired this morning?
Yeah, I think when you look through healthcare here, there's some decent charts. We focused on Hologic this morning. And
You're the second person today on like Dow Component, United Healthcare. Is that trendable?
We're not there with the managed care names. UNH and Elevance are the two big players there. I think they're weaker charts, but look at the big farmers. Merck is a very good long-term picture. That will be at the top of our list here.
And what's great about this, folks, is you got Chris Verone as a technician talking up Merck, and I know that's one of, as a fundamentalist, Bill Smead and his fabulous Smead Value Fund, that's one of his top holdings as well. We got to say that for another time. Clinic here with Christopher Verone with Strategas. I'll get a 3, 2, 1. Strategas, a Baird company as well. You want to learn more about that? It's simple. On technical analysis, read the books and start there. What we're going to do is at 12:15, a conversation, Bloomberg Technology, with Uber's chief executive officer. They're going to lift up the conversation on what appeared to be bang-up earnings as well. Futures -7. Stay with us. This is Bloomberg.
ECB is expected to hike rates, but how high will rates need to go, and how fast will they get there?
Are we underpricing here in Europe, and just how far the ECB could still go?
We really haven't seen an impact from the hiking cycle on inflation yet.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference. Coverage begins Thursday on Bloomberg, your global business authority.
Talk about Starbucks for a moment. You've been on the board for how long?
Wow, a long time, since 2006.
Okay, and when you got on the board, did you have to go to Starbucks every day and
I go to Starbucks a lot.
And
Yes.
when you check in, do you have to wait in line like everybody
Yes,
else?
I wait in line like everyone else. That's an important part of the process to see how everything's working, how long it takes, what's happening in the store. I take pictures of the cases. I do all sorts of things when I go in now.
So what's your favorite drink? Can you say? Is that a state secret?
I make a joke about this. So I like my coffee black like me.
Okay. Now, Howard Schultz has been a mentor to you a bit. Is that correct? He's the founder of Starbucks.
Sure, for sure. Very important.
So what did he do that made Starbucks so successful? There are other coffee chains around the world, and it wasn't like he invented coffee chains. What did he actually do that made it the biggest in the world?
He really started off from the very beginning saying that he wanted to create a different kind of company and that he had this point of view about leading through the lens of humanity. It sounds like it could be a cliche, but it's not at all. It is very much in the DNA of the company, how we look at things, how we do things. It's always through this point of view of people. And so at the end of the day, I think he put people first, not only in terms of the partners of the company, but also in terms of the customer. And at the end of the day, that is what has made the company so great.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Live from New York City this morning. Good morning, good morning. Equity futures negative about 0.2% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, the debt limit deadline may come as soon as June. The Federal Reserve's two-day meeting begins in Washington, and Morgan Stanley planning 3,000 more job cuts. We begin with the big issue, one and done.
Likely one and done in May.
One and done?
One and done.
I think one and done is probably the answer here.
If the Fed says one and done, you're going to see financial conditions ease.
I think the Fed has an incentive to talk a bit tougher.
Markets are in wait-and-see mode as to what Jerome Powell does. They have said that they're very data-dependent.
The number one issue for the Fed is not growth, it's not credit conditions, it's not bank failures, it's not earnings, it's inflation.
Clearly, there is a risk that inflation stays higher for longer.
Inflation, that's what matters.
That is true. Inflation is the bête noire of the economy.
They'll do one more.
100% of May will see another hike.
The Fed's job is not done.
Joining us now to discuss, Bank of America's Megan Swiber alongside Nuveen's Tony Rodriguez. Megan, first to you. Is this Fed truly one and done?
You know, John, we still have time to see whether or not that will indeed materialize, but our house view is that this will be the last rate hike of the cycle. But as was said up in that lead up, the Fed is still going to be in data dependent mode. What's still most important to the Fed is inflation. They're still going to be monitoring the data that comes in. What's very important here is whether or not there's been a shift in bank lending behavior, effectively tightening that the Fed thinks is already in the pipeline and basically will be felt by the economy. These are the things that the Fed will be having a very watchful eye on in the months ahead. House view is this is the last 25 basis point rate hike, but the data is still going to be very important here.
I saw that from Mike Gapen. Enough juice for one more hike. Enough juice for one more hike. Tony Rodriguez seems to be the view of a lot of people on Wall Street right now. I hear a lot about a conditional pause. And Tony, I want to know what it's conditional on and whether the bar for hikes is higher or lower than the bar for cuts of the Fed going forward from here.
Well, good morning, Jonathan. Good to be with you. And we do think the Fed is one and done. We don't think they're going to state that clearly because we do think the bar is still higher for cuts. Right now, the Fed has an inflation problem. As we look forward and we look towards the back half of the year, we do think you'll start to see economic weakness flow into the economy here. Tighter lending conditions, we think, are going to be one of the key drivers. But the evidence of that is still not clear enough to the Fed versus the evidence that inflation is sticky, it's much higher than their target, and their belief is that they need to at least pause at this new higher level, in our minds, for the balance of the year. So that means that the bar for a cut is higher than what the market is currently pricing in.
Bank failures haven't stopped them. The last time they met, a bank had just failed, they hiked interest rates. They meet this time, the two-day meeting begins today. They're about to hike interest rates tomorrow after another bank failed. We've had Silvergate, SVB, Signature Bank, First Republic, throw in Credit Suisse, that makes it 5. And Megan, yet still they've hiked interest rates. Can you think of a parallel, a moment in history that is similar to this one, where a central bank like the Federal Reserve has looked at bank failures and chosen to keep increasing interest rates?
Yeah, John, it's a good conundrum that you bring up here. And I think it really does suggest that the Fed has its credibility at stake here. If they're viewed as hiking into more banking failures, right, this is putting more pressure on the banking sector. But really, enemy number one here is still the inflation picture. And what we've seen from banks and the data that effectively the Fed has, we get this data on a weekly basis every Friday. You can monitor how banks' deposits are evolving, how their lending behavior has been evolving, and things seem to be stabilizing here. That's really the key word, and it's the key word that Powell and Secretary Yellen are very much so keeping a close watch on here too. Stabilization and still this very hot inflation does support the Fed going and delivering another 25 basis point hike. Again, the Fed thinks and believes that banking lending behavior is likely going to evolve in the coming months and create this additional tightening pressure on the economy. This is all to be seen. We'll get the senior loan officer survey for April, and will give us some indication of whether or not bank lending standards have tightened further. But still, enemy number one here is inflation. The science from the banking sector that we seem to be broadly getting is stabilization. Both of these two things together encourage just that additional juice left to deliver this.
It's kickstarted a process, that's for sure. Some might say accelerated a process that was already seeing some momentum, tighter lending standards, tighter financial conditions coming around the corner. This is the question we've got to ask, Tony, off the back of the banking stress of the last month. We've got to work out what kind of economic outcomes do the bank failures lead to, and ultimately how quickly those outcomes will materialize. How long will this take? What are, so to speak, and I've asked this a few times, Tony, the long and variable lags of a banking shock?
Well, Jonathan, there are long and variable lags, as you mentioned. We certainly are seeing that now with the bank balance sheets and the impairment to their asset side of the balance sheet, and that's what really, was a big part of what drove some of these failures. In terms of seeing it flow through the broader economy, we came into this with a very resilient consumer, with a very resilient corporate balance sheet. So in our minds, it is going to take longer to flow through. That's a strength we're seeing in a low unemployment rate. But as we look forward to the end of the year, our view is that you are going to start to see that. Our view is that we'll see a mild recession. It's likely to kick in early in 2024. At the very earliest, we'll start to see signals of that in the fourth quarter. That is what we think will eventually lead the Fed to start to shift to cutting rates early next year. But whereas the market is pricing a September cut, for example, we think that's way too early. And that's because the economy is going to be a little more resilient because of a strong consumer, and inflation is going to be a little bit stickier than what the Fed needs to see in order to be able to pivot.
You mentioned the economy and the labour market. On Friday's payrolls, just to give you a sneak peek of the median estimate in our survey so far, we're looking for something like 180,000 in Friday's jobs number. That's down from 236 in the previous month. Unemployment, expecting that to climb from 3.5% to 3.6%, according to our survey of economists on Wall Street and beyond. That's for Friday. We've got to get through the next 24 hours. The Federal Reserve just around the corner. Mike McKee, a busy week for Fed speak, the Federal Reserve, and for the data too?
Yeah, we can boil it down to maybe raise in May and go away. That's what the Fed would like you to think. So that will color the way they handle this meeting and the statement that comes after. The question is going to merge from the highest rates in 16 years to how long they will stay there. In after the great financial crisis, when they started cutting rates, it wasn't for 15 months after they hit the peak, 7 months after the 2008 or mid-2000s rate scare. So they don't always keep it for a year or so, but they have in the past. So that is the question. And there's no percentage in the Fed telling you that it's going to be cutting rates next. So expect a change in the statement this time to incorporate, much as they have the last 2 times they got to the peak, the idea that we could see rates rise again. Any additional firming, they said in 2006, some further gradual increases, no promises that they were going to do it, but the idea is left in the minds of the markets so that they don't think they can immediately price in something else. One other question is, and this is a number of people on Wall Street talking about it, do they need to do something about QT? This is the balance sheet here, and it has been rolling off much more slowly than the Fed anticipated. They're not reaching their caps, particularly with mortgages, because who wants to refinance or sell their house right now when mortgages are so much higher? And so the balance sheet is absorbing duration, and that's making the markets less sensitive to interest rates, and that is pushing down on financial conditions. So there's a theory out there that they might have to adjust the pace of their sales.
Mike McKee, thank you, sir. Let's pick up on that. That's a really important point. Megan, what's the story with the balance sheet, just to build on what Mike was discussing?
Yeah, I think the balance sheet is a really important point here, too. In our view, we are not expecting the Fed to tweak anything regarding the balance sheet, specifically at this meeting. We really don't see the Fed changing anything regarding its tapering of asset holdings until we see that first rate cut. We're not expecting that to happen until the first quarter of next year, after we see signs of a mild recession in the U.S. But things that could get the Fed to have to adjust the balance sheet policy before that effectively are concerns about financial market stress. So if we see periods of Treasury market illiquidity where the Fed needs to readjust its holdings, be that buyer of last resort for Treasuries in the market, those more liquidity dynamics are things that could kind of get the Fed to step back into the market sooner. But we are not expecting the Fed to adjust anything regarding its balance sheet at this meeting, and think that at the end it's really going to come down to the economy turning before the Fed recalibrates.
Just looking at Treasuries right now, the 10-year 355. Tony, I've got your 10-year call for the end of this year at 325. You think we've already seen peak inversion? I guess my question to you, Tony, this morning is, what's left to play for here?
Well, John, I think what's left to play for is a little bit of a tailwind from that modest decline that we're expecting. So when you kind of pan out to a really broad asset allocation, right now markets we feel maybe have a little bit too much optimism built into them. Our overall outlook is you want to be modestly underweight equities and overweight to fixed income. So we do think that that little decline in rates that we're expecting is going to provide enough of a tailwind to provide pretty attractive returns from fixed income asset classes. So it's a good hiding spot for investors who are concerned about that slowing economy that we see coming forward, and who are concerned about the Fed maybe overdoing it on the tightening side of the equation.
And Megan, on the inversion call, you seem to be on the same page. Are you retaining a long bias in the Treasury market?
Yeah, I think Tony makes a very good point here, too. If you look at history as a guide, you usually see 10s rally pretty meaningfully in the 12 months following the Fed delivering this last rate hike of the cycle. If this is indeed what we're seeing, this is the end of the Fed's hiking cycle, now is a good time to be buying duration. I particularly like buying duration in real yields, effectively the inflation-protected product, because I think that really at the end of the day, the story of whether or not the Fed's hiking cycle is over is going to come down to the inflation story. But yes, buying duration last hike makes a lot of sense.
Megan, you're going to stick with us, Tony, as well. We're going to talk about the debt ceiling in about 5 minutes, so don't run away. I know that deep down you really want to run away because no one really wants to talk about the debt ceiling, but they will have to in Washington next week, and I'll get to that in just a moment. Equity futures on the S&P 500 this morning, negative 0.25%, with some movers going into the opening bell. Here's Katie.
Let's kick off with 3 earnings stories. Let's start with Uber, because consumers still spending in a big way on rides and food delivery. Adjusted earnings were $761 million in the first quarter. That was well above the average estimate of $678 million. You can see shares up about 8.4%. Moving on, Pfizer too beat on estimates and on profit and revenue. Of course, it's struggled with the drop-off in demand for its COVID shot. It's looking for more growth avenues. Shares treading water here. Let's move on, though, because Chegg, John, this is fascinating. Chegg, it's an education technology company reporting earnings yesterday, and it warned that ChatGPT is threatening the growth of its homework help services. John, this is what disruption looks like.
The kids are cheating on their
Apparently.
homework. Apparently. Katie, thank you. Coming up, DC gets a new debt deadline.
The most immediate thing we can do is ensure the continued reliance of our economy and the financial system.
President Biden setting up a meeting with top lawmakers. That conversation with AMH and DC up next.
Many people recognize you because you have a very famous hairdo that I've asked you about before. But to some people, they may say, well, Ken, what happened? Where did that hairdo come from, and where is it gone? Because right now, it seems a little different than what I've seen before.
Yeah, it's growing out a little bit, David, but COVID, you know, I ended up with hair going back down to my shoulder, and I finally realized that one of the things I had to do, I'm a very loyal person, and I used to have hair down to my waist in my college and my hippie days before that in Ann Arbor, Michigan, and I had it cut off in the summer of '75, and I've gone to the same person, now a grandmother many times over, who was a young gal cutting hair in Amherst, Massachusetts, and I still seek her out, and I finally just said to her, you know, COVID's enough of a change that I ought to be able to do something new.
This is Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
The most immediate thing we can do is ensure the continued reliance of our economy and the financial system. The most important thing we have to do in that regard is to make sure the threat by the Speaker of the House to default on the national debt is off the table.
And what was your second question? Debt limit. The president still hasn't talked to me.
A new debt limit deadline turning up the heat on Congress. Secretary Yellen said in the X-State, writing in a letter to congressional leaders the following: "We will be unable to continue to satisfy all of the government's obligations by early June and potentially as early as June 1. The House did its job. Now it's on Biden." That's the message from Speaker McCarthy, writing the following: "There's a bill sitting in the Senate as we speak that would put the risk of default to rest. The clock is ticking." The administration responding with an invitation calling top lawmakers to the table. A GOP aide confirming McCarthy will attend that meeting. For more, let's head down to AMH down in DC. Anne-Marie, just some movement here in the last couple of days.
Yeah, it's really the opening start of these negotiations, Jonathan, but it is progress. You had Speaker McCarthy get this bill through his House. What that does is it does lift the debt ceiling, but it comes with fiscal spending cuts, and he maintains that he will not pass a clean debt ceiling. He has to make sure that he has spending cuts attached to that. But this is something that the White House says they cannot sign off for. They want a clean debt ceiling bill. But at the end of the day, the ball was in Biden's court after Speaker McCarthy was victorious in getting his caucus together. And now what President Biden is doing is not just inviting the Speaker of the House, who, yes, will be attending that meeting next week, but he's inviting all of congressional leadership. So what many are saying, this is progress. The big issue they have, Jonathan, of course, is the timeline. Even this week alone, we have the House in recess. You have Speaker McCarthy in Israel. And then when they come back, it's a very short timeline until they get to June 1st, with Treasury Secretary Janet Yellen saying potentially that is the first date as soon as the U.S. can exhaust these measures of how we are paying our bills.
Anne-Marie, I have to say that May 9th, which is a week from today, doesn't feel like panic stations, all hands on deck. Does it feel like panic stations to you?
No, it doesn't, because if it was all panic station, hands on deck, you'd have them there tomorrow. But again, Speaker McCarthy's not even in the country right now. He's leading a CODEL till Israel. He spoke at the Knesset yesterday. That's where he got that question. That was before Biden picked up the phone and called him, and he said, I haven't spoken to the president. He continues to say, and he's told me in 2 interviews last month, that he has not spoken to the president since February 1st. And he wants a sit down. He wants that meeting. So May 9th, that puts it out to a week. And then, of course, Jonathan, the president's going to be leaving on 2 key international trips to Japan and to Australia. So it's getting very difficult for Washington to act in time. And that is when people are concerned. And if you look at Greg Vallier's note, he says he's now calling this really a debt crisis. And the issue is, what many say is potentially Washington won't act until Wall Street panics.
AMH, I don't see much sign of panic just yet. Anne-Marie, thank you. No. I see signs of repricing, so let's be clear about that. The prospect of the ex-date falling a little bit earlier than anticipated. You look through the T-bill curve across various maturities, and the at-risk security seems to come in just a little bit, and one of those T-bill yields popped just a little bit yesterday. Now, Megan, can you walk me through what you're seeing in the T-bill curve, so to speak, and where the ex-date might fall, and what the at-risk securities look like right now?
Sure, Jonathan. So effectively what Yellen is doing here, in our view, is guiding the market, guiding policymakers really towards this band of uncertainty around when Treasury is going to be running out of financing. So this early June number really does make a lot of sense. So some of our projections for when they can ultimately hit that X date run to late July to early August. But we do think that Yellen is giving the market and giving policymakers her view on ultimately what the highest probability looks like in terms of trying to build in some error band around all of these forecasts. These are hard numbers to get right effectively at the end of the day, and Yellen doesn't want to be caught off guard by giving the market and giving policymakers a date that's later than when these measures are effectively exhausted. And you're right. Effectively, the bill market is responding to Yellen's guidance that we saw yesterday. But at the end of the day, the story is going to be, as we look forward to the next few weeks, right? And it seems like, as was mentioned, we haven't really seen signs of outright panic yet. Ultimately, the bond market, the longer-term Treasury bond market, is going to be what we will see respond to this. Probably likely to see more of this risk-off flow, more of a bid for longer-dated Treasury yields, which does seem a bit counterintuitive.
So buy bonds is still the story. Tony, bonds get into trouble, buy bonds. And to be specific, Treasuries get into trouble, buy Treasuries. Tony, that raises a question. Is there any risk outside of the at-risk securities? Is there any risk at all outside of those securities?
Jonathan, we think that there is. So, the debt default hand grenade right now is in the hands of both sides, and they're going to use this for political theater to score some points. But as we get closer to the X date, whether that is early June, even though we think that's a conservative assessment by the Treasury, and we agree that it's in a more of a mid-late July, early August timeframe, as the timeline gets tighter, you're going to see volatility increase. And the risk is that you can see this suddenly begin to really crimp the capital markets. And as that debt financing becomes less available, as volatility rises, that's going to impact, obviously, capital market pricing. And that's when you can start to get into some scenarios where, companies may not be able to refinance. We don't expect that to be the case. We do think that ultimately the brinkmanship will lead to an 11th hour agreement to raise the debt ceiling, but the ability to have an unexpected accident increases the closer we get, and the markets are going to have to price that in.
Megan, the difficulty that I've got is that we're expecting, or rather you're expecting, the Treasury market to behave like it has DM characteristics when it's overseen by institutions which are displaying EM characteristics. Now, I'm wondering, Megan, at what point that story kind of flips and that people start treating treasuries differently. Now, it hasn't happened before. I'm wondering whether you think it's going to happen anytime soon.
Jonathan, it's not my view that happens. It's not really our view as B of A that we will see the Treasury debt credibility really get challenged in a meaningful way here. And the question really comes down to where else is money going to go at the end of the day. Treasuries typically and historically demonstrate this key quality of being the risk-free asset in the world. And as you mentioned, the key thing that will ultimately is getting challenged here is whether or not is the timeline of these payments. But regardless, it's effectively written in the amendments that the U.S. government should not be challenged in terms of its ability to pay its debts. And certainly this does pose questions and a lot of uncertainty around effectively volatility and political grandstanding in the term. It's ultimately still going to be the story of Treasury still needing to respond as the risk-free asset, because when we do see this pickup in volatility, we do think that's ultimately where money is going.
Our trust in this market is just amazing, and it gives politicians on both sides the luxury of acting irresponsibly when they so desire. Megan, thank you. Tony, too. Equity futures negative 0.2%.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it is causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Equities a touch negative. Let's get you some morning calls. First up, Morgan Stanley upgrading Dow to overweight, pointing to an attractive valuation. Roth MKM upgrading Penn Entertainment to buy, seeing a potential beat and raise quarter on Thursday. And finally, Citi downgrading Coinbase to neutral, expecting regulatory headwinds to continue. Coming up, Daryl Cronk of Wells Fargo remaining defensive ahead of a busy week of risk events. That conversation up next. Your opening bout just around the corner.
everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Three seconds away from the opening bow this morning. Good morning to you all this Tuesday. Slightly softer, negative, down about 0.2% on the S&P. The Nasdaq almost totally unchanged. Yesterday, the S&P 500 not giving you a relief rally at all, even with the solution provided to First Republic, acquired by JP Morgan. There's your opening bell. Switch on the board and get to the bond market yields. Down a couple of basis points on a 10-year, 354. Yesterday, really interesting session. The ISM manufacturing number came out. The prices paid component of it rebounded. That spooked people in the bond market, yields up. Meta and a bunch of other companies came to the bond market. That knocked the treasury market around as well. And we were higher by more than 10 basis points right the way through the curve yesterday. Still in at around 350 on a 10-year this morning. In the FX market, look out below euro. Euro dollar printed new highs for the year intraday last week, very close to 111, has backed away every day since. The euro is negative against the dollar for 4 straight sessions, the longest losing streak going back to late February. It's been a while since we've seen some persistent euro weakness. Outside of that, crude lower by close to 1.7%. We're back down to about $74.30. 45 seconds into the session, we're negative 0.3% on the S&P. On the Nasdaq, we're down by about 0.15. One stock to watch at the open, Uber, reporting a smaller than expected quarterly loss and delivering an upbeat outlook. The CFO said this: we delivered record profitability and free cash flow in Q1, and we're poised to expand profitability again in Q2. Ed Ludlow joins us now. Ed, these numbers pretty good. The stock with a pop.
Yeah, the stock with a pop up around 6%, biggest jump since November. On an adjusted EBITDA basis, Uber coming in at $761 million in the first quarter, significantly above street expectations and giving us that second quarter forecast of adjusted EBITDA, 800 million to 850 million, again, above what the street thought that they would do. There's some really interesting dynamics read through to consumer behavior here. If you look at gross bookings, $31.4 billion for the quarter gone, slightly below estimates of 31.5 billion. It's actually freight that dragged that down, a decline in freight. But if you look at the rider gross bookings, 15 billion above expectations. There's some data, I suppose, that points to the idea that riders actually may be taking more frequent rides. Definitely, this is a consumer base when it comes to ride-hailing and food delivery that is kind of weathering the storm and doing well. I guess a question for Dara Khosrowshahi going forward, Jonathan, is how long does this last? You know, it's a pretty bullish outlook that they've given for the second quarter on an adjusted EBITDA basis. But again, note that freight decline being a slight drag on gross bookings.
Well, that's a question you can ask the man himself. I know you've got an interview coming up in about 3 hours from now. I'm looking forward to it. Dara Khosrowshahi, the CEO of Uber, sitting down with Ed Ludlow and Emily Chang. Ed, what's the focus of that conversation going to be a little bit later for you and the team?
Yeah, for me, I try and get the macro picture. I really do think that this is a consumer that's holding up if you go by gig economy metrics. We don't see that everywhere else, right? We're trying to discern with crystal balls through this earnings season what the outlook for the second half of this year looks like. If you go to the semiconductor sector, they'll tell you we're going to recover. Do they see the sustained demand from their riders, and how are they going to keep that demand going through the latter parts of this year? I'm really interested in freight, Jonathan, because if that dropped off, it declined in the quarter gone. What does that tell us about global logistics and supply chain?
Ed, looking forward to the show. A couple of hours away, Bloomberg Technology. Ed Ludlow sitting down with the Uber CEO alongside Emily Chang, I believe. That's going to take place on Bloomberg TV a few hours from now. About 3 minutes into the session, equities just a little softer, negative 0.4%. Uber a whole lot higher, up by 7%. Let's stick with earnings. MGM Resorts under pressure, despite delivering a Q1 beat. Analysts expecting a slower summer in Vegas to weigh on shares. Katie, that stock down 2%.
Indeed, there's a disconnect here between the numbers and what the market's doing, because this was a big quarter for MGM. Of course, this quarter might not repeat itself when you think about what could happen this summer, but apparently everyone is going to Vegas, at least for now, at least in the first quarter. Revenue in that market, which of course is MGM's largest, it soared 31% to $2.2 billion. Adjusted earnings jumped by more than 40%. And Macau, too, it posted a big rebound, John. That business more than doubling. And in both of these markets, of course, this is in some ways a pandemic story, especially in Macau. A lot of that rebound, of course, coming after the country lifted those COVID-19 restrictions. All told, MGM earnings overall, they came in at 44 cents per share. The average analyst estimate, just for context here, was just 10 cents. So a big beat, but as you can see, traders apparently not too impressed. MGM down 2.5%. Caesars, too, is under pressure. That company reports after the bell.
Not a shocker, just a little lower. We're down about 3% on MGM, as Katie indicated. That's the story for them. Let's talk about Big Pharma. Pfizer out with better than expected results, doubling down on its forward guidance. The CFO had this to say: our strong balance sheet will continue to provide the flexibility for future dividend increases and share repurchase activity. Kelly lines that stock up by a little more than 1%.
Yeah, even though the guidance is unchanged, John, but that move, the 1% move higher here at the opening bell, was driven by really sizable beats on the top and bottom line. Earnings per share coming in at $1.23. The street was looking for 97 cents, and primarily that was driven by stronger than expected demand for its COVID-19 products, both its antiviral Paxlovid as well as its vaccine, performing better than expected. And one analyst over at Wells Fargo saying in large part that's due to the demand driven from China, as well as a government contract mostly being delivered in the first quarter. However, I would note that when you look at that shot revenue, for example, came in at $3.1 billion, still represents a 77% decline from the first quarter of last year. So a smaller drop than expected, but still objectively a pretty large drop. And our analysts here at Bloomberg Intelligence are saying today that these results are, quote, nothing to get excited by, noting that ex-COVID sales actually missed expectations by about 1%. And our very own Sam Fazeli saying the fact that the guidance is unchanged shows how hard it is to forecast COVID-19 revenue in 2023. And I would note that 2023, as a result, has been pretty tough for the stock. Even though it's up 1% today, it still remains lower by more than 20% this year, John.
Kelly, thank you. Thank you very much. That stock is up by about 1% right now in early trading. 6 minutes into the session, we are negative 0.4% on the S&P 500. Doing a little bit better, relatively speaking, on the NASDAQ. We're down by, let's call it 0.16% on the NASDAQ composite. For the broad bond market, yesterday yields much higher. This morning yields essentially unchanged at the front end. The 2-year, let's call it 4.13-ish. On a 10-year, 3.55 yields come in a couple of basis points. The view on the Fed. The meeting starts today, concludes tomorrow, and here's what you're going to hear a lot of over the next 12 hours or so. One and done. That is the consensus on the street. Darryl Cronk of Wells Fargo also calling for another 25 basis points, telling investors to stay defensive ahead of a busy week. Writing this, the risk-reward dynamic is not currently attractive. Darryl joins us right now. Darryl, wonderful to have you on the show, with us, buddy, as always. Darryl, I wanted to start with this quote, and it came from my team here at Bloomberg Intelligence. According to the data, as of last week, nearly 81% of S&P 500 companies have beaten analyst estimates, the biggest proportion since the third quarter of 21, and yet this. The median stock has outperformed the index by just 0.1% on the day of results. Darryl, why aren't these stocks being rewarded for decent earnings?
Yeah, I think that's exactly right. I think it's because people are still, John, worried about what the future holds. I mean, if you look at the earnings estimates from today, we're tracking about $51 to the quarter for Q1. Fourth quarter still has all-time record highs for earnings. It's hard to paint that path of consensus estimates on where we're going. So what's interesting to me is both the earnings still have to come down, which is not a new story, right? But companies are not getting rewarded for any kind of beat that they have. Margin pressure is there. And what was quiet about April was everybody talked about what a great month April was for the index and everything else, and we know the narrow leadership in that story. But the two best performing sectors in the month of April were healthcare and staples, both defensives, right? So you're seeing defensive start to take over. The leadership and the earnings estimates just don't sync right now, and that's why we think the risk-reward dynamic here, we're half of 1%, I guess is the way to say it, off of the 6-month high for the S&P. It's just not worth it in today's world.
Darryl, what would be worth it? What would drag people out of the cash they've piled into over the last 12 months? I'm looking at money market funds just exploding. There's so much money that's gone into them over the last year, Darryl. What would pull them back out?
I think you've got to see the natural order of the cycle play out. So, I mean, everybody knows this, but think about it logically. You know, you have an inflation shock, followed by a rate shock, followed by a bear market, which is where we are right now, followed by a recession, which is where we think we're going, followed by rate cuts, and then followed by the next bull market. So you've got to get to that rate cuts and bull market. You know, history tells you, if you look at this, John, the bottom in the equity market, in the S&P 500, doesn't come until after the first rate cut historically, and it's typically about 5 to 6 months after the first rate cut. So you tell me, we don't think the first rate cut happens in 23. We think it probably happens in 24. But even if you take the most aggressive estimate of 23 and then spin forward 5 or 6 months, you've still got a while here where we need to kind of reset valuations and multiples where the risk-reward becomes attractive. The equity risk premium is still 125, 30 basis points. You need that number to be 250, 300 to really bring cash back in at an attractive valuation.
And let's get into it a little bit more. The missing piece of this, and I think you alluded to it there, Darryl, the missing piece of this, we've had the rate shock. We haven't had the credit reality check. Are there reasons to believe that we will?
That's right. Well, again, if you use the idea of a natural order of things, what typically happens in these cycles is you have a liquidity shock, which you could argue is happening in March and April with the stress in the banking crisis and the failures, followed by a profitability challenge, which we think we're in right now, right, where margins are getting squeezed, profits are getting challenged. And then what typically comes with varying time lags is a credit shock. So we think that lies before us. You can debate the materiality, you can debate how much, how deep. But I would note, John, and this is really important, what people are missing about what the bond market is telling you today is that the length of the inversion of the bond market of every major yield curve. It isn't the basis points, it's the length. Now, we've had the 3-month to 10-year inverted 6 months and the 2-year to 10-year inverted 12 months. Those are both very consistent time frames with when recession sets in after the initial inversions.
Do you think, Darryl, this conversation we're having goes some way? In fact, maybe all the way to explaining why the regional banks are struggling to get off the mat and rally. Yesterday, even with the First Republic solution, KRE down 2.8%. This morning, down another 1%. The Russell underperforming. There's a big tilt there towards the financials. The Russell down by 1%. Darryl, does it explain why the regionals have struggled to rally even with solution after solution being offered over the last month or so?
Yeah, I think there was a lot of people out yesterday saying, look, the JP Morgan First Republic deal or solution, if you want to call it that, you know, is the end of this crisis. If that were the case, we should be seeing a bigger rally yesterday and today out of financials, and they're nothing, right? There's just no activity there. So I think the combination of people worried about some of the small, medium-sized business models, what is coming in more regulation in that space, which actually, you know, depresses earnings or leans on margins, and the idea that net interest margins eventually get squeezed, I think probably has that area. If I'm looking at attractiveness today, John, if I can get a 3-4% dividend on financials at 1-time tangible book or 8-9 times earnings, or I can get a 3-4% dividend on energy at the same multiple, I'm picking energy every time.
The energy story is interesting to me, Darryl, and has been for a long time. Primarily because a lot of people offer me quite a bearish scenario on the economy and financial markets, yet still they come out with a long on energy at the end of the conversation, Darryl, and I often ask the same question. Why can that be? How can that be? How can you have this negative view on what might happen in the US economy and in financial markets, yet still like energy?
Yeah, I think that is the question to ask, and it's the smart question to ask, John. I mean, the reality here is you have to weigh what's going to play harder and more. Cyclicality, which is what you're alluding to, or the long-term supply-demand dynamics. One is a short-term story, one is an intermediate and long-term story. I do think, and that's why you're seeing, WTI oil prices back down about on top of where they were on last month's OPEC Plus cuts. So we've brought oil prices down nicely to reflect that cyclicality, to reflect what's probably a deteriorating economy in the back half of the year. That said, if the economy is heading into the recession, which we still think is our base case, you should have oil more like $30, $40 a barrel, and it's simply not. And the reason it's not is because the world is short long-term energy sources, and oil being one of them, fossil fuels being one of them.
Yep, heard that argument a few times. Daryl, thanks for being with us, to give us some clarity on how you're thinking about the market right now. I appreciate it, always do. Thank you, Daryl. Daryl Cronk there on the latest from Wales. KRE, the regional banking ETF, is down by close to 2% right now. TCW President Katie Koch, formerly of Goldman Asset Management, you might remember her from coming on this program, over the last few years. She had this to say on the regionals over at Milken to the team over in California at the moment. Regional banks is an area we're concerned about because of deposit flight, and also they have the highest exposure to commercial real estate. We heard something similar from Charlie Munger of Berkshire Hathaway to the FT over the weekend as well. There seems to be a reluctance to dip a toe into these names, and there's got to be a reason for that. Even after the solution for First Republic, you are not seeing a rally. Coming up on this program, another bank, another round of job cuts.
Like every institution, you make some adjustments around the capacity, but we're playing the long game in investment banking.
That conversation up next.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, the big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy, but man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. The moment news breaks, no one covers the world like Bloomberg.
It would be, of course, a total disaster for Emmanuel Macron because he's been elected on this reform and he would have to basically start from scratch.
It definitely is an exciting day for Apple. First
store in India, here in downtown Mumbai, a second one coming up in Delhi.
TK, we've got a lot to talk about.
Debt, China, and the shockingly cautious view the IMF has on the view 5 years forward.
Bloomberg, your global business authority.
We have a lot of talent that wants to come and join us, and we've been bringing some terrific talent in the healthcare sector, in the technology sector, and investing in that. Like every institution, you make some adjustments around the capacity, but we're playing the long game in investment banking.
Another round of job cuts hitting Wall Street, this time from Morgan Stanley. Bloomberg reporting plans to slash as many as 3,000 positions, or 5% of its staff, making it the bank's second round of layoffs in just 6 months. Bloomberg's Shonali Basak joins us now from Milken in LA. Shonali, wonderful to catch up with you. We know that this side of the bank has been difficult, and now we're starting to put some numbers on it slowly.
Yeah, absolutely. We had a fear that we would get to this point again, given the environment, John, has been weak for many, many months. But here's the thing, it's that the end in sight is not quite close. When we talk to a lot of bankers, they're starting to push the horizon out even into 2024 potentially for deal making to come back. Now, there are signs of life in the capital markets, debt issuance ticking back up after a very long slump here. But again, it's not enough to keep staff on board in mass. So we've seen thousands of job cuts here being planned at Morgan Stanley, 10% of the workforce or more over at Lazard. And then you also have Bank of America fairly recently, just months ago, saying that they would cut hundreds as well. Remember, they've been cutting kind of hundreds here and there as needed. Now, again, 2024 is no promise. And not all is bad. Over on the buy side, for example, we still have hiring here at the private credit firms. But remember, some of these firms like Apollo are coming off of hiring near the top of their range at the end of last year. Still hiring this year, just maybe not at the paces they're seeing before. Now remember, if you couple that with what you're seeing, for example, at Credit Suisse, where again, UBS, Credit Suisse, you have even more job cuts underway with the integration. And then if we see more bank consolidation as well, that could also mean more synergies. You have a lot of capacity in the market here, supply coming up of talent, and none clear about where all of that talent goes, especially because you don't have competition from other industries the same way you did prior to when we saw the rate tightening cycle here. So again, not clear how much more pain there is to come, but certainly this is the start of another wave.
Shonali, we've all been following the conversations that you, together with Romain and the team, have been having over the Milken conference. Can you just give us the tone of things around regional banks right now? I saw those comments from Katie Koch just yesterday. Not really encouraging, were they?
No, she definitely came down harder than many, many others, but there are a few tones that a lot of people have hit here. That commercial real estate worry, Mark Rowan over at Apollo even saying he sees a second wave coming. The office vacancies numbers being a lot worse than many people realize. That is one part of the larger commercial real estate sector, but one manager told me it is a small part of their portfolio, but like most of their problems. And so certainly until that shakes out, it's unclear how deep the pain can get. And from the perspective of the folks here at Milken, the market has not repriced to reflect that reality. So again, a lot of things on the sidelines here to be watching out for in terms of more pain some of these money managers can feel before they start feeling a little better and being able to enjoy the other parts of portfolio that they're starting to dip into here as some valuations start to become more depressed.
Brilliant work. Just looking forward to the coverage through today as well. Shonali, thank you to you and the whole of the team on the West Coast at the moment covering these issues. Want to get back to the job cuts, not just Morgan Stanley, but AI starting to disrupt the labor market. IBM CEO saying he expects 30% of its back office jobs to be replaced by artificial intelligence in the next 5 years. Want to bring Ed back into the conversation. Ed, that is a big number, isn't it?
It is a potentially big number. So IBM CEO Arvind Krishna joined us in New York yesterday across some Bloomberg reporters and editors. And you're right that it's focused on the back office. So IBM has 260,000 staff globally. Around 26,000 of those are back office. So at 30%, you're looking at around 7,800 jobs. In the first instance, what Krishna was talking about was pausing hiring in areas where it looks like those roles in the future will be displaced by AI. What an IBM spokesperson later clarified after that conversation was that could also be just through attrition, right, as part of any reduction rather than sort of active layoffs. Also interesting to get the economic outlook from somebody like Arvind Krishna, right? And he basically is somebody that did not see a recession in 2023. He told us yesterday in that conversation, Jonathan, he now sees a shallow and short recession by year end.
Him and everyone else seemingly sees the same thing. Thank you. A very consensus view there. If you missed the promo a little bit earlier, look out for Ed Ludlow sitting down in conversation with Dara Khosrowshahi, the Uber CEO, together with Emily Chang a little bit later this morning, about 2 hours or so away on Bloomberg TV. In the broader equity market, about 23 minutes into this, we're negative 0.4% on the S&P with a sector price action. Back with us, here's Katie.
More losers than winners on a day like today. Let's look at some of the winners. You do have healthcare in the green, as to is discretionary, as to is that tech sector, but still really small gains, small losses too, except if you look at energy way down there at the bottom, off by 2.7%. Then you have materials and financials on the back foot as well. And let's quickly go to some education stocks, because on the back foot as well, after we heard that AI warning from Chegg, really having some ripple effects here.
Katie, thanks for that. Coming up, your trading diary up next.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Let's call it 26 minutes into the session. We're negative here by 0.5% on the S&P. Down just a touch on the NASDAQ, negative by 0.1. Real underperformance in the small caps, the Russell, negative more than 1 full percentage point. That's the price action. Here's the trading diary. What a week. Factory orders, durable goods at the top of the hour. The main event tomorrow, Fed decision, Chairman Powell news conference. Then it's the ECB's turn on Thursday. After the bell on Thursday, Apple results. And finally, rounding out the week with the U.S. payrolls report. The median estimate in our survey so far, 180,000 from New York. That does it for me. This was the countdown to the open. This is Bloomberg.
many people recognize you because you have a very famous hairdo that I've asked you about before. But to some people, they may say, well, Ken, what happened? Where did that hairdo come from, and where has it gone? Because right now, it seems a little different than what I've seen before.
Yeah, it's growing out a little bit, David, but COVID, you know, I ended up with hair going back down to my shoulder, and I finally realized that one of the things I had to do, I'm a very loyal person, and I used to have hair down to my waist in my college and my hippie days before that in Ann Arbor, Michigan, and I had it cut off in the summer of '75, and I've gone to the same person, now a grandmother many times over, who was a young gal cutting hair in Amherst, Massachusetts, and I still seek her out, and I finally just said to her, you know, COVID's enough of a change that I ought to be able to do something new.
The difference between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking, the bus was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and scientists launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids